Recording in progress.
Good evening, ladies and gentlemen. I'm Tirthankar Patnaik from the National Stock Exchange, and it gives me great pleasure to welcome you all to the third and final day of the 9th NSE NYU Conference on the Indian Financial Markets. Today, we have a rock star speaker, Professor Michael Spence, the 2001 Nobel Laureate in Economics. So without further ado, let me pass the baton to Professor Coase John of NYU Stern. Over to you, sir. Please.
Thank you. Let me add to the welcome all to the third day of the NSE NYU conference on Indian capital markets. I have the pleasure of introducing Michael Spence, our keynote speaker today. Michael Spence, as we all know, he got the Nobel Prize in 2001. He was my colleague at NYU Stern. He joined us in September of 2010. Now he is a senior fellow of the Hoover Institution and the Philip H. Knight Professor Emeritus of Management at the GSB Stanford University. As I said, he was awarded the Nobel Prize in Economic Sciences in 2001 and the John Bates Clark Medal from the AEA in 1981. Mike, of course, has done work in many areas. His scholarship focuses on economic policy in emerging markets and the impact of leadership on economic growth. But of course, in my mind, he's most famous for his work on asymmetric information and Spencean signaling in the labor market. I was telling the people here that my own work in financial signaling had been on that framework. So I sort of think as Mike's Nobel Prize as the most deserved Nobel Prize. Now, Mike he has also been the chairman of the Independent Commission on Growth and Development from 2006 to 2010. Global policy group focused on strategies for producing rapid, sustainable growth and reducing poverty. He also serves as a consultant to PIMCO and a senior advisor to Oak Hill Investment Management. And of course, he's a board member in several companies. Mike, I'm going to pass the floor on to you. We're all looking forward to your keynote speech.
Well, thank you, John, and thank you, Tirthankar. I'm really pleased to be with you. I'm going to see if I can share a screen, and then I'll tell you what I'm going to talk about. So let's see if I can find my presentation. Here it is. Okay. All right.
Yes.
You can
Everything
see
is good. Yes.
All right. Okay. So what I'd like to try to, this isn't strictly narrowly finance, although I do think it's relevant to the financial world in India and many other countries. But I want to talk about the digital economy, the kind of major transformation that we're under, and specifically a very extraordinary period in the last few years in India as the mobile internet spread. I should say, I continue to be interested in the informational structure of markets, and of course, in the digital era, the informational structure of markets is being transformed in some dimensions. So, I don't think I've totally abandoned my earlier work in this area. So here we go. Let me see if I can make this thing change.
Yes,
here's a brief tour of where I want to go. I'll, with apologies to my Indian friends and colleagues, I'm going to give a brief background on the digital economy in India, and then I'll spend most of the time in one way or another talking about the recent, and very unusually rapid expansion of the mobile internet in India, which we all know is A, important, and B, is really the kind of core of the transformational part of the digital transformation that we're under. And then I want to suggest that you talk a little bit about growth and development models and using this specific case to suggest that sometimes this sharp distinction we make between the public sector investing in public goods and the private sector, building on the enhanced investment opportunities needs a little bit of a rethink. And with using this as an example. And some other themes. Down at the bottom here, I say if there's time, I would have liked to talk about some major transformations, but I don't think we're going to have time. So here we go. In the 1980s, I was a dean of the Faculty of Arts and Sciences at Harvard, and we got kind of personal computers. They weren't really connected to the internet, so they were fun and kind of cute. But it was the kind of dawn of the democratization of digital technology, and this, of course, was before the World Wide Web, and not to mention the mobile internet. But Rajiv Gandhi was a fighter pilot and loved technology, and he, I believe, and his colleagues initiated an attempt to expand the education in digital areas, in computer science and so on. And I remember a delegation coming to the United States. They visited Harvard and a number of other institutions, where the question was, how do you go about building the human capital that underpins, an area like this? And then went back and did extraordinary things in India. So you had the proliferation of really outstanding Indian institutes of technology, which have produced extraordinary graduates who are leaders in the Indian tech sector and even globally. I mean, the CEO of Alphabet is a graduate of one of the IITs. And that's, then the World Wide Web came along, was invented in 1989, probably 5 years later, started to become broadly accessible. And so we saw the growth of the internet. We started using email. We had the World Wide Web. The process of transforming virtually all information to digital form, got accelerated at that point. And of course, we were well along on that path. And that combination of the early investment in significant human capital and the opening up of the digital space to pretty much everybody gave rise to very important employment growth engines in India, in IT administration, software development, customer service. You all know this, business process outsourcing. That was a major step forward, and India was clearly in the lead in that area. And then the mobile internet came along, and it's this is written so much about it. I won't dwell on it, but this is what created the opportunity essentially to expand the penetration of the internet to eventually pretty much everybody who's mobile and on the earth. But it's not very old. I mean, the speed is just breathtaking. So the first iPhone, which most people think of as the first truly internet-connected device in the full-blown sense, came in 2007. So it's just 15 years old. And it did revolutionize access to digital services globally. But it came at different rates. And the key parameters that determine what happens after you have the mobile internet spread out are the costs of the equipment relative to the incomes of the people in the society, the costs of data measured in, how much do you have to pay per gigabit of downloaded data, and the speed, right? So at 2G and 3G speeds, streaming is not very interesting or important. At slow speeds, e-commerce, is not very interesting, or it doesn't work very well. And so these key parameters are important determinants of the not just the penetration, but the range of potential use. And so, so let me take a moment and shift over to China. So China, when this started in the early 2000s, China had probably the fastest rollout of the mobile internet anywhere. And they accomplished that in ways that were typical of the Chinese growth patterns. The major telecoms were all state-owned enterprises, which means essentially that they could do what they were told. And they invested heavily, if you were standing back from this would be quasi-public sector investment, state-backed investment that produced a quite rapid rollout of the of the mobile internet at costs that were consistent with the incomes of the people, the citizenry. And that created a kind of infrastructure or market conditions for what has turned out to be kind of just explosive growth in internet-based services. And you all know what they are. I mean, very rapid growth of e-commerce. E-commerce is, in terms of penetration, is the highest in the world in China, and certainly among major economies. Fintech, mobile payments, just a host of things, and an explosion of entrepreneurial activity associated with them. And studies, that have been done, although we have more to do, suggest that one of the effects of this kind of growth built on, so you have the mobile internet, it creates an opportunity for a whole lot of investment, startups, new ideas, innovation, entrepreneurial activity, and so on. And once that gets running, then you have opportunities for, what are quite decisively inclusive growth patterns. So again, when you look back over, 15, 20 years at the commentary, this isn't terribly surprising. I mean, one of the hallmarks of the digital technologies is they're relatively disrespectful of things like distance and, compressed time delays and so on. And so it isn't terribly surprising that when you go and look, you discover that the biggest sort of impact in measured relative to the starting point occurs in, for example, low access populations. So, if you live in a city like Mumbai, you have access to all kinds of services ranging from retail to medical to so on. If you live in the countryside, then the range of services that are available is much less, or certainly, the cost of accessing those services is higher. And the internet, and mobile internet in particular, because that's how people access it, becomes much more important part of your life. So whether it's e-commerce or access to various healthcare services, these are all things that are now expanding at a dramatic rate, including, especially in India, because of the rapid expansion of the mobile internet. And then with digital data and artificial intelligence in its kind of modern current form, machine learning, neural networks, and so on, this is something, if we had more time, I would spend more time on. You can close informational gaps. I mean, you can conduct an assault on the adverse selection problem is one way to describe it. So for example, with the kinds of data that get accumulated in the e-commerce and mobile payment systems, you have enough data to make credit assessments of people who are otherwise essentially anonymous to the system. No real track record that's easily accessible, very expensive to deal with through the traditional channels of credit extension, including banks, no collateral to speak of, etc. So you get in multiple dimensions the potential for inclusive patterns of growth and enhancement of well-being. So let me talk about how this happened in India, as I understand it. I mean, obviously, a detailed account would have more steps in it. But India is following a path that's similar to the one that you saw in China. It's a little bit later. But up until 2016, India's mobile internet was On the supply side, quite fragmented. And the data rates were relatively slow. Most of the country was operating without 4G. And the data rates, the speed was slow, and the data rates, meaning the cost of data transmission into the smartphones, was relatively high. But in parallel, and before that, around 2010, thereabouts, I may have the date slightly wrong, Reliance Industries bought a small company that had competed in and successfully acquired the spectrum licenses for 4G for data, covering pretty much all of India. And Reliance Industries bought that firm, and it became Reliance Geo. And then Reliance invested quite a lot of money. I mean, I haven't got the figures exactly right, but multiple billions of dollars in building out the kind of fiber optic infrastructure you needed to run a kind of relatively high speed, sort of mobile internet with stations and so on. And then this is the part that sort of intrigues me. In 2016, Geo was launched with a program of selling very low-cost smartphones to Indian citizens and very, very low data rates. Now, I'll show you the data in a minute. But not surprisingly, this resulted in a huge expansion of mobile internet penetration in India. Now, some of it was at the expense of the existing competitors, who had to bring their costs down, but a lot of it was just incremental. Geo acquired 40 million subscribers in about 4 years. It was close to 1 million subscribers incrementally every month. And this process is not done. So, I expect as India's economy continues to grow at relatively high rates and incomes rise, the penetration will continue to go up, just expanding the sort of, ecosystem in which the internet services and all of that get built on. So that was extraordinary. And so in a very short period of time, and without, obviously the regulators had to approve all this, and they did approve making the spectrum that Reliance Industries had got usable for voice as well as data under 4G. So that helped a lot. But it created the conditions for what you see happening now in India. Now I'll see if this thing goes forward. Yeah. So here are the costs, relative costs of the mobile internet around the world. I don't take these numbers too seriously. These are 2019. So Geo's been running, for about 3 years here, and you can see India's data costs are this is the cost per 1 gigabit of data downloaded to the mobile device, and you can see these are extremely low, by virtually any sort of standard of comparison. Now, in high-income countries, you probably expect the data rates to be a little higher, but in India they're very low, probably lower. And I'll come to this in a minute, lower than you could justify on the basis of rate of return on investment, just providing, mobile internet access via smartphones and data rates. But this is a transformation. These are the data costs in India over a period of time. So if you go back before Geo, the costs were really quite high. And they came down and then dropped suddenly and then dropped again. And now these numbers aren't exactly the same as the previous ones, but they're not that far off. So I don't want to spend an excessive amount of time on this, but sometimes forgotten in the calculations about internet penetration is what does it get used for? And, can you really do the full panoply of things on it? And that has to do with data and data costs, which is why I emphasize it. Now, this is, to me, the interesting part. Reliance Geo didn't stop there. You know, in 2019, they created what is come to be called Geo Platforms. It's a wholly owned, or was at the time it was created, a wholly owned subsidiary that included the smartphones and the data service plans, but set out to create a growing array of downstream digital businesses. And then, and this is very striking, in the first half of 2020, Geo Platforms essentially opened up and started taking external financing. And within about a 3-month period in 2020, when the pandemic was running, they raised $20 billion from leading global players in the digital internet service space, including Facebook, now Meta, Google, Alphabet, Intel, Qualcomm, and a list, I'll show you the list in a minute, of A-list private equity investors. So an enormous infusion of capital. And I believe that Reliance Geo still owns approximately 2/3 of this, holding company called Geo Platforms. And then what took off is this rapid development of apps under the Geo heading, but others, this is an open kind of platform. So people started coming in a whole range of areas: cloud, AI, Internet of Things, and more. E-commerce, online retail, mobile payments, etc. So let me go back. So here's just the investor group coming in. And you have Facebook with by far the biggest investment. They now own, on the order of 9.9%. Google eventually in. You can read this, so I won't go on. You have sovereign wealth funds here, major players in the growth equity space, like Silver Lake, General Atlantic, KKR, TPG, etc. So obviously, this was hugely attractive with from the point of view of sophisticated investors, from the point of view of, what did their original Geo program open up in terms of investment opportunities, entrepreneurial activity, innovation, and so on. And I think what's happening now is that it's all coming to pass. So here's Reliance Industries. This is the ownership of Geo Platforms, has about 2/3. And these other folks with a $20 billion investment overall have the other third. And there you see the percentages. They at least may shift around a little bit, but I think it's basically right. And here, Geo Platform apps have grown rapidly. So this is a list as of relatively recently of the kinds of, mobile internet-based services that are being developed on this platform. And it's pretty impressive. I mean, you have health, you have security, you have cloud services, etc. So it's not the whole growth story, but it's a pretty major, important part of it. So India has essentially joined a pattern that's quite global and very striking. So it wasn't many years ago in the tech sectors in which you could count, on the fingers of two hands, the places that were, major sources of technology companies and innovation. That pattern is really shifting. And so this is you can count these things in a variety of ways, but this is a picture, a relatively recent picture of the, unicorns that are being created. So the United States is still very prominent. China has become very prominent because of an earlier rapid deployment of the mobile internet. India is now, on the same path and is showing up with lots of companies that are not only startups, but, acquiring very substantial values. I should say that, having a big market, a big addressable market, either because you have a big population or a rich population or some combination of the two, is important. I'll come back to that because these technologies, once you find kind of winning ones, tend to scale, very relatively easily, I guess is the way I would put it. But you can see this spreading out. Here we have Brazil and, even France. Paris has become a hot spot. In general, Europe is lagging in digital technology development, but there's still a fair amount of activity here. And underlying this is a kind of, a global spread of and this is finance in a way, a kind of globalization of the ecosystems that enable this kind of entrepreneurial activity. So the single most important part of that is the underlying technology itself, right? But also there's the financing, the kind of knowledgeability, the kind of complementary resources that the supportive ecosystems bring. They get built over time. It doesn't happen overnight. But it's institutions, expertise, human capital, a lot of things that support this. So it's quite striking that it's becoming a kind of global activity. This is a slightly different count, but I find this pretty interesting. This is consistent with other data that I've seen, which is a substantial fraction of this kind of activity is occurring in the fintech sector, and it's not surprising, I guess, because finance is a bunch of services that handle information transactions, contracts and stuff. And they, and so it's kind of naturally digital anyway. If you look at studies, say by the McKinsey Global Institute or others of, digital penetration by sector, then the tech sector and the finance sector come out in usually pretty high, depends on where you are, but pretty high in terms of digital adoption. And so it's a kind of setup, but then in fintech, you also have this very rapid accumulation of data once the mobile payment systems and other things come in. So I think this is, a very distinct kind of growth area for sure, but it's not the only one. So you have health. We tend in economics to think, when we talk about growth, to think about the standard measures of growth and things related to it, like employment, like productivity, etc. But the impact of the internet is much broader. It'll have, the whole thing that I'm talking about now is going to impact healthcare. It's going to impact education. It's just, it's very broad. And this is a picture of, this is just 2021 of Indian startups that have achieved this $1 billion valuation. I don't know all these companies, but it looks like an impressive list, and it's quite broad in terms of kind of which sector, which space they're occupying. So I would say, if you kind of stood back from this, the result so far is that India is once again, somewhere near, or maybe, and in some cases at the frontier in many aspects of the digital economy. And I think it's fair to say we're only getting started with this. This is not, we're not anywhere near the end of the cycle. I'm sure that the biometric identification system that India created in the past 15 years and has implemented, helped as a kind of foundation for getting this all done. An important point is that you might think, and people did think, including investors, that one of the reasons for the rapid expansion of these of the mobile internet and digital services related to it, is that, you find a model that works in one place and then you simply transplant it to another place. And that turns out not to be true. That the things that work from the point of view of investors are models that are specifically tailored to solve local problems. So in India, you have had a relatively fragmented retail sector. It needs to have digital services, more efficient supply chains, higher quality supply chains, etc. These are all problems that local entrepreneurs understand and solve with the support of these ecosystems that are built up around them. So despite the fact that it's kind of a global phenomenon, the specifics kind of really matter. And it is a kind of local, we're going to solve a problem that's kind of here and now using the digital technologies. There's something else that's happening in I don't know if it's come up in your other sessions, but with I think everybody knows that in the past year, roughly a year, China has significantly increased its regulatory activity in the tech area. Across the board, e-commerce, management of data, market power, where the data resides, capital requirements in the fintech sector. It's really quite broad. And this has created uncertainty from the point of view of investors, especially external investors. And as a result, a lot of the attention that was being directed toward the China opportunity set is being redirected toward the Indian one, which is very large and significant as well. And so there's sort of money pouring in to India. This is a global phenomenon, but the valuations are becoming pretty high. We probably all have colleagues and friends in the investing area in private equity. And the commentary that's coming out of that is there's lots of interesting companies out there, but in the course of due diligence, it's frequently true that you find that there's everything about this company is interesting, except the valuation's too high. And so people are having to pass. It's also, I think, a little bit of euphoria. There have been some recent IPOs, including a couple in India, that didn't go so well in the sense that the valuations didn't hold up. And there's a bit of a pullback from the tech sector, I think, driven by the uncertainty in China and the increased regulatory scrutiny that the sectors these collection of sectors are getting pretty much everywhere, in Europe, in the United States, and so on. And for good reason. Let me say, this isn't regulators and policymakers making a mistake. There are serious issues here about abuse of market power, about how data is responsibly managed and should be regulated, about data security. It's made much more complicated by the kind of dual use of some of these technologies in the area of national security as well. So it kind of elevates the stakes. But anyway, so this is going on. We are moving into a more heavily regulated set of tech sectors than we experienced in the first 15 years of its life. And now I'd like to just say something, if I stand back from the story I've just told you, hopefully reasonably accurately. The first point is that the high penetration of the mobile internet and the low-cost data is a little bit like infrastructure. We wouldn't really call it infrastructure, in the narrow sense of the term. But it's like infrastructure in the context of growth models because it's a kind of quasi-public good. Once it's in place, it creates a huge set of investment opportunities for private sector investment, which is also what infrastructure does when done properly and properly targeted. for this private sector investment and everything we've just talked about, entrepreneurial activity, increased efficiency and scope of markets, accelerated inclusive growth patterns, and employment. And so it creates opportunities for private sector investment, and it generates social returns that even the private sector investors, don't appropriate, right? So the combination of those two things means that sometimes, and this happens to be an example of it, you get much, much larger, private and social returns than those that accrue to the investors in the platform, in the original mobile internet itself. So in this context, I would say that if Geo had invested only in smartphones and low data rates and the infrastructure to run that whole system, and then left it at that, it probably wouldn't have been a profitable investment, or at least marginally so. But of course, it was that combination that gave rise to the very rapid. So they created the platform. So how did Reliance Geo get a decent return on the investment? And the answer is they integrated forward. So they created the platform and the investment opportunities, and then they invested, not to the exclusion of others, but they invested heavily in the opportunity that they had helped create. And then when you aggregate that, then the returns on investment, including the original return, original investments in creating, for want of a better word, the platform, the environment, the digital environment, then the returns start to look impressive. That's a pretty unique way of getting from A to B. But one thing I think is worth noting on the way through, and that is, integrating forward into the service providing space, sitting on top of the mobile internet, means essentially competing with your potential competition with your customers, right? And so not the people who are walking around with mobile phones, but all the other people who are doing business there. That's, I can imagine a competition authority blocking that. And, they've done it in other contexts and disallowed forward integration, which creates the potential for conflict of interest. But they didn't do that in the India case, and I think by and large it's kind of worked out pretty well. But if these technologies are as powerful as I think they are, and many other people think they are, then the question is, is the Indian model going to work everywhere? And I think the answer is no. All right. I mean, this is a pretty unusual case where the return that generated a lot of benefits over and above the original investment was going to have to be augmented by something. And I think the way it's going to happen in other places is that there's a very strong argument for subsidizing, however you go about doing it, subsidizing the creation of the platform, because it opens up so many growth engines, of a digital nature, once you get it done, or once you get it, expanded to a point where it becomes really interesting. And the other thing is India has a very big advantage that I mentioned before, which is that the scale of the addressable potential market. That's true of China. That's true of India. It's true of the United States. There's a question mark about Europe because we, in the service areas, we're still a little bit fragmented from a regulatory point of view. There's still a fair amount of activity here, but and they're higher income economies, so you don't need quite as much scale as measured by numbers of people as you do, in India, even though its growth is going to be spectacular in the future. The other thing I wanted to mention on the way through is that, we all know that we are moving in the direction of adopting a broader view of measurement of economic and social progress than that is, than that associated with, the conventional measures of economic performance, GDP growth, etc. And when you look at that, then you see that the impact of these digital transformations is really quite extraordinary. I mean, so I've just put two examples up here. There are a couple of young people at Stanford who decided to use kind of image recognition, which is a major breakthrough in the application of artificial intelligence to diagnose skin cancer. And so they went to the dermatologists in the university and hospital and said, would they be willing to collaborate and try this? And they worked very hard and created a training database of, I think, 100,000 or so images. And they borrowed the image recognition engine that had been developed at Google, which is pretty expensive to develop, classical pattern of cost structures in the digital area. And it worked pretty well. It didn't work so well that you'd replace, the AI with dermatologists, partly because they don't do biopsies and a bunch of other things. But there's a fairly large fraction of the world's population that doesn't live really very near a dermatologist. And the most mobile devices have a pretty decent camera in them, and you can send the images over the internet and have them reviewed. And so this is an example of inclusiveness. It happens to be in primary healthcare, primary and preventive healthcare. You can just serve a very much larger population, essentially by giving them an early warning system. So if something looks really problematical, when a family member takes pictures of your skin, then you can incur the expense in terms of travel time and cost to go get it sort of looked at properly and taken care of. In India, there's a challenge in the area of diabetic retinopathy, which is a disease which causes blindness if not detected fairly early. And similarly, you can take pictures of the retina, and the AI systems are getting better at detecting whether there's a real problem there, and therefore triggering a sequence of events that leads to earlier treatment than might have occurred otherwise. China got there with public sector investment, and India got there with a kind of inspired bit of investing and sort of structural transformation in this part of the economy, and then forward integration. But I think the point that I want to make is the benefits are huge, and only starting to be fully realized in terms of inclusive patterns of growth and things related to it. And I think it's a legitimate place where governments need to consider stepping in and accelerating the process by participating in the investment process, whether you do it directly or not. There are other examples of this. DARPA, some of you know, is an entity in the United States, Defense Advanced Research Program. It was designed originally to accelerate technology for military and national defense purposes in space. And these are very high risk, frequently fail, high return investments, ones that probably, are not going to be undertaken by the private sector. And that one, there's no guarantees that these things will work, but that one worked pretty well because it gave us the internet and the semiconductor, among other things. But we have had sort of something vaguely similar in vaccine development, very large amounts of public sector investing, not only in the vaccine development, but in manufacturing facilities, so that that process was accelerated by, probably a factor of 5 to 10. in much of the world. And now there are similar entities being created to try to accelerate the development of technology, technology for climate change, including accelerating the private sector investment. So I think what I'm trying to say is, what I'd like to leave you with is the sense that there's something that we need to add. Maybe digital is going to turn out to be exceptional, but I don't think so, or there'll be multiple kind of versions of it in which you can change the trajectory of the growth and development patterns fairly substantially if you can identify these sort of things that tend to move slowly because the private sector investment doesn't come together. The returns aren't high enough. But once you create it, then you have opened a whole set of investment opportunities that are really quite extraordinary in terms of private sector investment, and then eventually broad-based economic and social benefits, including growth. So that's most of what I wanted to talk about. Briefly on fintech. I've already said this is a major area of penetration for these technologies. Maybe the most important one, or certainly one of the most advanced ones. If you go back and kind of look at the evolution of the kind of fintech space, we had, e-commerce developed early. The eBay model was extremely influential in helping people understand that you could create digital markets, you could give people access to markets that were much more expensive, or at least, or even non-existent in the kind of offline world. But these e-commerce markets had an interesting problem, which most people call a trust problem. So what was that problem? Well, the problem was, people were dealing sort of anonymously with other people, and the buyers didn't think they were going to get the product, and the sellers didn't think they were going to get paid. And to solve this problem, most of the e-commerce players went into the business of creating something to facilitate these transactions, and they were essentially like real estate operations. They were, I've forgotten the word, but basically what the platform said is, well, you can trust us. So we'll collect the goods and we'll collect the payment, and then we'll send the payment and the goods. And so you don't have to worry about whether you trust each other. You just got to trust us, because we won't pay the seller until we get the goods, and we won't, etc. Maybe you see what I mean. It was an escrow operation. That's the basic thing. A friend of mine in Ant Financial told me that that was the origin of Alipay, what became Alipay. And the technology they used initially for that, this was in the late 90s, early 2000s, was the fax. They used a fax, very high-tech stuff. And these evolved into digital payment companies, primarily digital payment companies to support the e-commerce. But the interesting thing is they migrated to the rest of the economy, basically. And so now when you fast forward, you have mobile payment systems developing everywhere at different rates that cover increasingly large fractions of the entire consumer economy. That's very advanced in China, moving rapidly in India, in part, I suppose, because of the movement to reduce the use of cash. But once these things get started, cash sort of starts to semi-disappear because it's so efficient. There's lots of people where the penetration of this is high, where they don't carry wallets at all, or anything to carry cash, or they just take their mobile phone. The impacts of this are really quite extraordinary. It's much more efficient than other payment systems. I mean, relative to credit cards, I would say the costs per transaction in the mobile payment systems are on the order of a quarter to a fifth the cost. So eventually they'll just take over. The innovation in China was the two-sided use of the QR code. So it allowed vendors, people selling stuff, including very small ones who might not have invested in sort of equipment to get this job done, just to be able to do it with just a QR code. So a seller in China can scan your QR code, or you can scan his or her QR code, and the transactions will go through. But from the point of view of the development of fintech, probably the most important thing is it generates absolutely huge amounts of data. And that data is the fuel for artificial intelligence systems, for credit scoring and other things. And so you create the, once you have a mobile payment system and e-commerce systems, you're starting to create very large amounts of person-specific data on their patterns of activity and so on. You can misuse this data for sure, so hence the regulatory activity. But you've got the basis for as I said, closing those informational gaps that I talked about before. Essentially, what happens is that in the digital world, people don't, they don't necessarily behave differently. They don't necessarily buy different stuff, but there's a record of it. Right? All of a sudden, there's an accessible record of it that can be used in beneficial ways. So it can also be misused as well. You also, from a macroeconomic point of view in these systems, you have a real-time window, and literally real-time window into what's happening in the economy. It used to be said that if you wanted to know what was happening in the global economy, ask DHL or FedEx, because they could see it coming before you could. I think that's still true to some extent, but in the digital world, you have much more rapid feedback on what's happening in the economy. This turned out to be pretty useful in the pandemic. I mean, the people used Google mobility data to figure out literally exactly, what was shutting down, what was still working, and so on. All of it. Everybody knows that the digital technologies were a source of resilience in the pandemic economy, because a lot of things kept running that would have either had to shut down or run at extreme risk to people and so on. The distributional aspects of that were not particularly benign, because the people who can work, on the digital platforms tend to not be in the lower income range. And so the pandemic economy has been an adverse adverse distributional shock, in spite of the fact that it was a source of resilience. And there are other, consequences of this accumulation of data. It's a source of market power. I'm not sure about this in India, but it's certainly true in China that it ran with relatively little regulation, including capital requirements. So it created a kind of non-level playing field with respect to the traditional players in finance, the banks and others. And so the regulatory activity is in part designed to A-level that playing field and prevent, risks associated with running with, limited or no capital requirements, in things like credit extension and so on. So all of this is a work in progress, and it's too soon to know where it'll end up. So let me kind of finish up here with just a couple of concluding thoughts. One of the reasons the digital technologies are so powerful is because they tend to have high development or fixed costs at very low variable costs. Software replicates at virtually no cost data can be used multiple times. It's a non-rival asset, if you like. And so they scale relatively easily. And that gives big economies or, a certain kind of advantage. In terms of sponsoring entrepreneurial activity, the entry barriers are low. I mean, you don't need a lot of capital initially. Maybe you need a fair amount to scale, but you don't need a lot of capital to sort of develop it. At the platforms, one hopes, are largely open. And so I think that's related to this pattern of, it is actually for sure related to the pattern, the globalization of entrepreneurial activity that we're seeing. And then, of course, the economic and social benefits are sort of fairly large. In other dimensions, I basically talked about the mobile internet and kind of what it's going to bring to us. There are other dimensions of the digital transformation. I think I'll just mention them very, very briefly. Given the progress in sort of artificial intelligence, image recognition, sensors, materials, and dexterity in advances in robots. Basically, I think we're on the threshold of having, on the threshold means 10 or 15 years, of having manufacturing and a good part of logistics become essentially not labor intensive. That doesn't mean there won't be anybody there, but I mean, this is, I think, pretty easily foreseen in the not too distant future. And that has multiple dimensions of impact. One is, for global supply chains, probably at least for the production of goods, the production and movement of goods, of a pretty major reconfiguration of how global supply networks, chains or networks are put together, how they function, how much localization will we get. If you don't have to go to find large amounts of low-cost labor in order to get things done in that dimension. We're not talking about services, and all that kind of thing. But in this dimension, I think, the other one that's a matter of significant interest to lower income developing countries. I mentioned lower income because by the time you get to middle income, you're basically moving away into a different structure and a different set of growth patterns. But for the lower income countries, the best known, model, stemming from the work of Sir Arthur Lewis and then the Asian experience and so on, is the export-led, if you access global demand because it's way bigger than domestic demand, you need something to sell to it. What's your source of comparative advantage? Answer: labor-intensive, process-oriented manufacturing and assembly of things like electronics and whatnot. This revolution in kind of robotics and related technologies is likely to make that growth model much less powerful. And so one of the reasons, and this is a matter of kind of both research and kind of interest, policy interest, is one of my reasons for being interested in these other dimensions of digital technology is that there's going to have to be a replacement for the traditional sources of comparative advantage in the not too distant future, or there's the risk that there won't be powerful enough growth engines to power growth. But all of these things are kind of happening before our eyes. So if I had more time, and I don't think I do, I'll show you what I would have done. I would have talked about major transformations in the global economy, and especially I would have talked about the technologies that are powering it. Because the thing that strikes me, it sort of sits below what we've been talking about today, is there's incredibly powerful technologies being developed in the area of digital, biomedical science, even prospectively in the in the energy transition, which are three of the major transformations that are underway in the world. And not only are these technologies powerful, but they're experiencing rapid declining costs, and they're widely available both to researchers and entrepreneurs. And I think they're the reason why we're seeing this extraordinary pattern of progress in a number of areas in biomedical science and so on. But I mean, they're fun to look at, but I don't think I have time. So, John, and let me give it back to you, and we'll move on to questions.
So, Mike, can we take another 2 minutes for a couple of questions, or is that okay?
Yeah, I'd love
Mike?
to. Yeah, no,
Okay.
I'm not going anywhere.
So let me start. Thank you very much. Let me start with a couple of things which you didn't really talk about. One is, we always talk about how India has one of the youngest labor forces among the major economies. You didn't talk about that. And the second thing is India, as you know, recently had a big financial inclusion exercise in the Prime Minister's banking experiment. They opened something like 350 million bank accounts for the unbanked. I don't know how you see that as interacting with the forces that you talked about.
So on the young population, I mean, I think that there's several things to say. For India, provided the employment engines run fast enough, it's an asset. If the employment engines, this is in general true, if the employment engines don't run fast enough, and I'm not terribly worried about that in the India case, although there is the worry about, growth without significant employment growth. But anyway, if you get into the position where you can't grow fast enough to employ the young people who are coming up through the system, then this thing that's an asset turns into a liability. I mean, you can see that clearly in some of the sub-Saharan African countries where their fertility rates are, very high, like 5, 6, 7, even. John, I've never seen a growth model that produces employment fast enough to keep up with fertility rates at that level. But that is not India's problem. The second thing is, if you look at the entrepreneurs, they're young. I mean, they just are young, and we are increasingly living in a world, in which the younger people view the digital technology that surrounds us as the way it's always been, normal, right? They don't really have terribly difficult problems adapting to it. So they for sure need an education and so on. But I think, the young people, are going to find it easier to navigate through this transition than some of the older folk. So that's a all major transformations, including this one, are pretty disruptive. Some jobs change. We didn't talk about that today, but new skills are required, etc. And I don't think there's a kind of big employment problem, but some people disagree with that. On balance, I would say, as long as India keeps up, it's at or near its full growth potential, which is very high at this stage. I'm talking, at least 8%, not without, occasional bumps, but then I think the young people are an asset, and you don't have the problem in a world that's experiencing increased longevity of, higher dependence ratios, which, is very, very difficult to deal with, in all the places where it's happening. I mean, you can see it clearly here in Europe.
Thank you, Mike. Let me see if there are a couple of other questions. Anybody with a question for Mike? Tirthankar, are you able to find questions in the chat? I'm not. Oh, there is something here. Yes.
Maybe I should look at it.
No. What is your opinion on observation about digital growth during the pandemic? Second question is, you said that high cost of mobile internet data was the reason to keep the low record of internet users in India. But later, while discussing the cost comparison on the internet, the table shows that India is in number one place, provide the services at the least compared to all other countries. What's your comment on that?
Let's see. Can you read the first part of the question again?
Yes,
John?
the digital growth during the pandemic.
Oh, yeah, that one's easy. The pandemic produced a huge acceleration to some extent in innovation, but to an even greater extent in adoption. So that all the tech leaders say, we had 5 years of adoption in 3 months. So what's going on there? I mean, basically, I think it's a well-known behavioral characteristic that individuals and institutions have a characteristic that might be called inertia. That is, we experiment too little. We do what we did yesterday too much. And not all those experiments are successful, but essentially the pandemic was an environment that produced forced experiments. And some of them will stick. The ones that will stick are the ones that, gave rise to learnings about the use of digital technologies as a complementary resource. So take education. Nobody thinks that we're going to switch to digital in education, right? But just doesn't. It's not a substitute for people interacting with each other at every level for lots of reasons. For young people because you skip the social dimension completely, etc. But we learned a lot of things, and we can use these technologies to enhance and enrich our educational things. I'll tell you one other story. There's a company that I got not to know very well, but I know about, that was doing appointment scheduling in the healthcare area. But scheduling appointments is kind of useful. At some point before the pandemic, they thought, well, now we know the healthcare sector pretty well. Why don't we sort of experiment with telehealth, remote interactions between doctors and patients, maybe augmented by a growing set of technologies that enable kind of home diagnostics to be a bit better than they were. That was a complete failure. No interest on the supply or the demand side. People wanted to go to see the doctor or go to the emergency room. Doctor said, I'm not dealing with somebody, over the internet. It's literally zero. Pandemic came along and they all had to try it, right? And now it's a growing sector. With lots of new companies and so business. Why? Because it's, more efficient, it's more convenient, it's more a lot of things. Will we never go to see a doctor? No, right? Will we do it, will we have a different balance? You can say the same thing about a whole lot of things. Hybrid working. I don't know how that's going to work out, but nobody I know thinks that an organization can function indefinitely if nobody's really ever been in, contact with somebody else, because the culture doesn't survive very well and so on. But will we have a different pattern of working? Will we do international things in a different way? Maybe travel a little less? Probably. So I think the pandemic, like some shocks, has knocked us out of one equilibrium, and we'll settle into a different one kind of when we get out. And the key is experimenting, learning, and adopting, I think.
So Mike, two questions on the kind of dark side of the digital economy. One question is about the digital economy concentrates a lot of data in a few hands. Should that be regulated? That's one question. Second question is, will the digital economy increase the income inequality?
Yeah. So the first one, the sort of simple answer is yes. You have to, you have to regulate it. Now, what's actually going to happen, I think, is still a work in progress, right? So, but you're going to get regulations in multiple dimensions. So, I think you can't rely on the private sector entirely to secure the data, right? The incentives aren't high enough, or to manage it according to a set of principles that are generally agreed on. So, we're going to have regulation that, give people rights. I mean, data is useful mainly when it's pooled and shared to some extent, little silos of data. This is my data, this is your data, that doesn't do much for you. So you have to pool it, and once you start doing that, then you need rules, essentially rules. And it goes beyond that. I mean, these companies that, say do mobile payments have huge amounts of data. I mean, I think what you're going to see is what's actually happening in China, which is the government is stepping in and saying, you're not the only people who get to use this data, right? We're going to turn it into something that has kind of quasi-public, I don't mean the public, but, other entities like banks are going to be able to use it. Because that's the way the system should run. So yes, I mean, the answer is it must and has to be regulated. Maybe for a period of innovation, it was okay to let it run, with pretty light, somewhere between light and no regulation. But those days are over. I think pretty much everywhere. Will we all end up in the same place? No. In some places, I think the government will, say we have the right to look at all the data when it's important. In other places, that's not going to work. And so there's sort of deep differences between societies in this respect. John, the second part of that was?
The second was whether it would increase in income inequality. Yeah,
I mean, yes and no. I mean, one of the things you observe, one trend that's easily observed is if you look at publicly traded companies and ask what fraction of their market cap, John, correct me if I'm wrong, what fraction of their market cap is accounted for by tangible assets on the book? And the answer to that is that used to be a really high number, say 20, 30 years ago. It's declining.
Right.
Yeah. Fair?
Yeah.
So what are those? So the intangible assets are things that we kind of vaguely understand, although I'm not sure we measure them very well. They're brands in some case, they're intellectual capital in some case. A lot of it is this digital, sort of. And when you look at just grab a list of the sort of highest market cap companies in the world and take a look. And you're going to find a significant representation, more than a significant representation of the mega platforms, because they scale, because they have these high fixed, low variable costs. They can serve huge populations at negligible marginal costs. They can deliver, free services to countless millions of people and then make it up on advertising or something like that. I mean, it's extraordinary. That probably is increasing wealth inequality just in that dimension, right? I would think, right? If you look at the kind of billionaires, they're not all tech people, but there's a growing number of them. And if you go down the wealth spectrum, those assets are created by a relatively small number of people, and they're owned by those people and a relatively small number of investors, right? So yes, I think it'll take us in that direction. On
Mike,
the last comment,
yeah,
John.
Go ahead.
But there is this inclusive growth pattern part that I tried to talk about. So it's that's my son, not my dog. So weighing those up against each other is kind of, we don't know how to do that yet.
Okay, one quick question, and then I want Tirthankar to ask a question. The question was, has the pandemic speeded up the adoption of fintech and other, blockchain applications, DeFi, and things like that?
Yes. I mean, I think the general answer is yes. Take the developed countries, for example. One of the reasons we're slower than probably, and certainly than China and probably India will be too, is that we have these legacy systems, a developing country doesn't need them. If you got a mobile payment system, you don't need credit cards and checks and debit, even a whole bunch of other things. I'm not saying you don't have any, right? But if you got a more efficient solution that's relatively reliable and operates on a pretty reliable network, why bother? So one of the things you observed in the pandemic, because of the desire to have contactless payments and a bunch of other things, was a noticeable acceleration, actually, on some dimensions of fintech in the developed world that were being held back by the legacy systems, right? So you've got. I was wondering when PayPal was going to get around to being able to read QR codes. Well, they're there, right, etc. I think Apple Pay is expanding pretty rapidly. Last time I was in the U.S., again, John, you can correct me if I'm wrong. It was hard to find something you couldn't pay for with Apple Pay. So yes, there's a clear acceleration, and I think on a broader territory, blockchain. That's a complicated. You've probably discussed this with people who are experts. My view on blockchain is it's a really interesting, important technology, but I'm one of the kind of I don't know what to call myself on crypto. The so-called cryptocurrencies are not currencies; they're an asset class. I'm not terribly interested in them myself. Anything that volatile can't be a currency. It's just rubbish. Right. We will have digital currencies because we're going to have digital everything in the payments, system and the whole finance system. So we got to have a currency. The central banks have to have a fiat currency that's digital that goes along with that. So we'll get there. At varying paces. Blockchain has lots of interesting uses though in tracking stuff, right? In supply chains, yes. Blockchain allows you to know where everything's been. It's it kind of
yeah.
So I think it's very so I'm not dismissive of blockchain at all, but it's not. I don't think it's. Central banks may use it to do secure transactions between themselves, and there may be other uses, but I don't think it'll be the libertarians are wrong. We're not going to replace our currencies with something no institution or government controls. It's my view.
Tirthankar, did you have a question?
I sure do. I'm also cognizant of the time for the conference. Okay. So all right. We have one hand raised amongst the panelists.
I see a hand raised. Prerna has a question.
Yeah, Prerna. No, not really.
Okay.
Can I take the opportunity to ask the last question to Professor Spence?
Yes.
Professor Spence, I just wanted to know how we can reconcile these, long leaps that India has made in the digital space with the relatively low standards of our school education. India does well. You mentioned the CEO of Alphabet is an Indian and who has studied,
IIT.
At one of the IITs. Yes, thank you, Koz, and you are from an IIT yourself.
That's right.
There are many, but and many CEOs have US CEOs are from India. But what ails the education sector, and how can we narrow this gap if possible?
So I think this problem of highly variable quality in the educational sector is very general, and it's very hard to fix. We just know that, and I think the digital technologies have a contribution to make. You have a burgeoning ed tech sector in India. You know, the chap who founded Baiju used to go around, I didn't know this until recently, and I've met him, used to go around and offer classes, you know, to sort of augment or fix the traditional educational channels in person. And, you know, and eventually they got, even though he's young and vigorous guy, it got a little exhausting. And the digital technologies came along, and now you have it's more than a unicorn. It's probably worth, you know, 13 or 14 billion dollars now. And it's not the only one in India. You know, I think this is a good thing, provided it's done the right way. China, as you probably know, essentially banned the edtech sector recently. And the reason they did that is because of their common prosperity agenda. They basically said, you know, so the edtech sector is something people pay for to sort of, you know, get their kids ahead, especially if there are deficits in the education system. And the unfortunate thing is that has adverse distributional consequences, because the people who can afford it, you know, aren't at the bottom of the income distribution. You know, so that's a fairly drastic step to take. Now, what they technically did is said you're in the nonprofit sector. I mean, that's whatever that means. So I mention that only to suggest that while I think, you know, by and large, you know, the digital technologies give you tools that can be used along with other measures to improve the quality of education. But it's not the only tool, and it certainly isn't the whole answer. But there are some risks associated with it. And in particular, you know, if you get in the East Asian economies, education and sort of getting into the right school and all that is such a high priority that, you know, families practically bankrupt themselves, you know, sort of going after that. You see this phenomenon in a wide range of countries. So you don't want to promote, you know, or create additional incentives for doing that. I mean, I guess that's kind of where I am on the education. Aside from the earlier comment, which is, you know, digital will never be a substitute for high quality in-person education, as far as I know. Yeah.
All right, Mike, it's an honor to have you speak to us. It was wonderful. Thank you so much.
Well, thank you for having me. I enjoyed it thoroughly. It's great to see you, John. Hopefully next time in person, okay? And
yes. Next time in Mumbai. Yes, thank you. Thank you, Mike.
If you'll ask me, I'll come. All right.
I'm delighted.
Thanks a lot, sir.
Mike.
Thank you.
Thank you.
Thank you. Thank you. Bye-bye.
Okay, one quick organizational question. Berisha and Joel, you know, we are running about 15 plus minutes. Is that okay? Is your plans allow that or not?
Coach, I'm okay with sticking to the schedule, but I will defer to Joel because I think Joel was expecting to discuss around now. So Joel,
yeah, I'm asking Joel. Joel, how is your schedule?
Coach,
does it allow?
My schedule is absolutely fine. I can run with wherever you'd like to have me speak.
I really appreciate that. Thank you. So we're going to stick to the original schedule, which means you guys will come on about 15 minutes, 20 minutes later. Yeah? Okay. Thank you so much. Okay, Kim, it's your turn now. Kim is going to talk about bank presence and health in India. Just the presence of banks improve health. Kim, you're on.
Fantastic. Thank you so much. I'm excited to share my research with you today. I'm a job market candidate at Columbia Business School. So let me share my screen. Okay, can everybody see my slides?
Yes.
Okay, great. So let's get started. Today we're going to talk about the relationship between finance, in particular bank presence, and health. So I want to travel with you to a relatively small village in India. So there was no bank in your area. And one of the consequences of not having a bank in the area is that there is little credit for local businesses. Okay? So there's little business activity, and you as a household only have a low income. Now, somebody in your family falls ill. So you worry because the money that you have from your job means that you cannot really afford to go to the doctor to treat the illness. Okay? And importantly, you also cannot rely on financial instruments to finance these costs for the doctor's visit. So you don't have access to savings accounts, to bank loans, or to a health insurance. And then there's another dimension of the problem with it, which is that it's not only the case that households cannot afford the visit to the healthcare provider, but the healthcare providers themselves are also financially constrained. So they don't have access to credit, which means that there's low healthcare supply. So ultimately, the households remains in poor health. So now let's think about what happens if a bank suddenly enters this village. So the first thing that we can think about is that this bank provides credit to the local businesses. These local businesses grow, and the household can benefit from higher income that they can now spend on the visit to the doctor. Importantly, the bank not only interacts with the local businesses, it is also going to provide access to traditional bank products such as savings accounts and bank loans. And very importantly, in the context of India and many, many other countries, actually the bank acts as an intermediary between health insurance companies in distant cities and the local household to provide health insurance as a product at the local bank branch. So now households can use these financial instruments to increase their spending on the healthcare. And then finally, another motivation for the study is that banks also interact with the healthcare providers directly. So they provide credit to the potentially financially constrained healthcare providers, and this could result in an important improvement in healthcare supply. So ultimately, the household recovers quickly from the illness and remains in good health. So here with a small narrative, I showed you strong motivations, how the bank can improve health in this kind of context. And despite these strong motivations, we don't have any empirical evidence on the relationship. And that is the main contribution of this paper. So in this paper, I'm going to ask the question, how exactly does bank presence affect health? And in order to identify this relationship causally, I'm going to use a nationwide natural experiment that was introduced by a policy of the Reserve Bank of India, the RBI. This policy incentivizes banks all over the country to set up new branches in certain treatment districts. And in particular, I'm going to use the identification strategy of a regression discontinuity design. So what do we already know on the relationship between financial development? So financial development includes here increase in bank presence, but also, for example, mobile money or mobile finance increase. So what we know is that we have natural experiments that show that financial development stimulates business activity and increases households' income. So these studies are very nice, and I encourage you to have a look at them. So now, one thing you might ask is, well, Kim, if we already know from other literature that households become a little bit richer if banks come in, can't we simply extrapolate and say, well, they must also become healthier? And importantly, there is literature that indicates that we need to independently evaluate the impact on health, because this literature shows that if we just give large amounts of income increases to households, there are no improvements in health. So in this context, income alone is often no silver bullet for improving health. Let me give you an example why this could be the case, is how if households benefit from higher income and can now spend more on health, but the healthcare supply remains of really bad quality, then health status potentially doesn't improve. There's also a second literature that doesn't use natural experiments, but randomized control trials, so experimental research. And this experimental research has shown us that simply providing savings accounts or also even credit products, there's very limited evidence, if any, that these kind of products improve health for households. So the main contribution of this paper is that it provides exogenous variation in bank presence to study the impact on health. So this is the first study that causally identifies this relationship. The second main contribution is that I'm going to provide novel evidence on two aspects of banking that, at least in academia, we have rarely thought about. That is that banks provide health insurance for households and they provide credit for healthcare providers. So let's jump into the design. The policy that I'm going to use was introduced in 2005, and the policy remains intact until today. So the main objective of the Reserve Bank of India was to incentivize banks to open bank branches in underserved locations across the nation. And in order to achieve this objective, the RBI relies on its authority to issue licenses for new bank branches. Now, the policy states that banks can increase their chance to obtain a license for a very popular location if they strengthen their presence in so-called underbanked districts. Okay? So if these banks wanted to get a license for a very nice location, they needed to set up extra branches in these underbanked districts. And the definition of an underbanked district allows for causal identification in this paper. So how does the RBI define an underbanked district? An underbanked district is defined as a district that has a very high population, but very few bank branches. And the ratio of the two, the population over branch ratio, is larger than the national average. So these districts are going to be underbanked or treated. So these are going to be the districts where banks are incentivized to enter. And in contrast, those districts that have a population over branch ratio that is lower than the national average are going to be districts where the banks are not incentivized to enter. So now, in 2006, the RBI published a list of these underbanked districts to support the banks such that they know where to set up the new branches. It did not update that list since. And importantly, that list only contains the names of the districts, which means that I'm going to reconstruct the population over branch ratio in this study. So, importantly, the design of this policy allows for the causal identification strategy of the regression discontinuity design. Here, the forcing variable is the district level ratio, and the cutoff is the national level ratio. And this is a fuzzy regression discontinuity design because I do not perfectly predict which districts are listed as underbanked. So let's look at first, how do I reconstruct the ratio? In the numerator, I have used population data from the population census. And in the denominator, I use the total number of bank branches from the 2006 branch statistics published by the RBI. While I do not perfectly predict which of the districts are listed as underbanked, because I do not exactly know what data sources the RBI used, I do a very good job at actually predicting which districts are listed as underbanked. So here on the x-axis, you see the district level ratio, so the population over branch ratio. And on the y-axis, you see the probability that a district is listed as underbanked by the RBI. And we see that as soon as the district level crosses the national average, this gray line, there's a large jump in probability that the district is listed as underbanked by the RBI. We can also look at the distribution of the district level ratio. So here, that's what we are going to have on the x-axis. This is just a histogram. And very importantly, how the RDD works is that we are going to compare districts that are located just above the cutoff to districts that are located just below the cutoff. So that means I indicated this here for you. We're going to mostly look at districts that are located within this range of this light blue bar and compare those to the right who will receive extra branches to those to the left who will not receive extra branches. Here you can also see a geographical distribution of the underbanked districts. We have approximately to the time of the policy introduction, 600 districts, whereby 63% of them are underbanked. So I combined the policy with multiple data sources. First, to show that banks indeed reacted to the policy, I'm using the bank branch data from the Reserve Bank of India. It provides total number of branch licenses and branches. Then to understand how these banks impact health, I first used the Indian Human Development Survey, or IHDS. Approximately 40,000 households were interviewed on a range of outcomes on health, but also their economic situation. And importantly, this survey gives me a pre-policy round. So this pre-policy round in 2004-2005, the IHDS1, allows me to test that the districts have equal health status or the households have equal health just before the policy. In other words, there's smoothness around the cutoff in health. And then 6 years after the policy introduction, we have another round of the survey that allows us now to test whether households have a significantly differently health status after the policy introduction. I also complement this with another health survey, the Demographic and Health Survey, or DHS, which has a very large sample size that allows me to capture low probability events such as miscarriages. And this was conducted 10 years after the policy introduction. And finally, because I'm not only interested on the impact of bank presence on health, but also about the mechanisms, in particular about the supply side, so about healthcare providers, I use the economic census, which has information such as what was the major source of financing of these healthcare establishments. And again, I have a pre and post policy round. I also use other databases such as the PROES or the SHRUG to provide more context. So let's look at the timeline of the study. We have the policy introduction in 2005, the household level surveys, the IHDS and the DHS, and we have also the economic census, which is going to inform the mechanism results, where the economic census is approximately 8 years after the policy introduction. Now, what exactly is a statistical specification? So as I mentioned, this is a fuzzy RDD. So basically, you can focus your attention here on the second stage. It's a fuzzy RDD, so it's a two-stage design, but you can focus on the second stage. I'm going to run both district-level regressions when I look at the whether banks reacted to the policy, and household-level regressions when I look whether households' health status improves. Here, H indices household, the district, and estate. So I show you here the household-level regression. And Y is an outcome such as whether the household faced any illness in the past month. So the household is going to be treated if it is located in an underbanked district. Okay. And here we have some econometric details. I use NSE optimal bandwidth and linear functions. I have state-level fixed effects and cluster standard errors at the district level. But importantly, let's look what I exactly compare with this econometric specification. So within a state, I'm going to, here, for example, Gujarat, I'm going to compare districts that are listed as underbanked, marked in dark blue, to districts that are listed as banked, so light blue. That means the districts in dark blue, we expect to have an increase in bank presence, and the districts in light blue, we expect to not have that increase in bank presence. And I'm going to look at outcomes a couple of years after the policy was introduced. So when are these districts comparable? The main identification assumption is that within the same state, districts that are located just above and just below the cutoff are comparable in all relevant aspects except their treatment status. And importantly, one major assumption that we need for that is that the local governments could not manipulate the ratio or did not manipulate the ratio to become treated. So these local governments have incentives to manipulate the ratio because they want to be listed as an underbanked district because they want to benefit from these extra branches. However, the construction of the ratio makes this manipulation really unlikely, because in the numerator, we have the population from the census, which is really hard to manipulate. And in the denominator, we have the total number of bank branches, which is basically a decision of all the banks. So it's also something that's really hard to manipulate. And I also don't find any empirical evidence of manipulation. So I use a Macquarie density test. And very importantly, just before the policy, these districts were located just above the cutoff and just below the cutoff, are smooth in terms of important variables such as, so they have equal bank presence before, equal health status, and also their equality in terms of variable related to potential mechanisms, such as how rich these households are measured by household consumption, their financial access, or variables such as hospital presence or general economic activity and population characteristics. There's also no evidence of other potential threats, which I'm not going to get into now. So let's move into the findings. I'm first going to demonstrate that the bank presence indeed increased in the underbanked districts. And here, so I'm going to show you the regression that I'm going to run just before the policy, and that's column 1 in 2004, and 5 years after the policy introduction. That's the second column. Okay. And so basically what we see is that there is smoothness in bank presence before the column. So the coefficient here in column 1 is insignificant. And then 5 years after the policy introduction, banks have 19% more branches in treatment districts compared to control districts. Right? So there's this large increase in bank presence, which means that the policy was successful in this dimension. We can also look at this graphically. So here to the left, you see smoothness before the policy. And let me just explain this again in some more detail. So everything to the right here are going to be underbanked districts or districts that have a very high population to branch ratio. And everything to the left are going to be the districts where banks are not incentivized to get into, so that have a lower ratio. And on the y-axis, we have the total number of bank branches. We see that before the policy, there's smoothness or no discontinuity. And after the policy introduction, we see how the discontinuity emerged. So districts to the right now obtain more bank presence than districts to the left. We also see that the dynamics correspond to the policy timing. That means just before the policy, there's smoothness in bank presence, and afterwards we see how the discontinuities emerge after the policy introduction. So now I want to move into the result that health indeed improves after the banks enter the districts. And I'm going to show you evidence that the morbidity rate decreases. So here, let's first look at the first column. What households are asked in the Indian Human Development Survey is how many days they were suffering from an illness such as fever, diarrhea, or cough in the past months. So these are non-chronic illnesses. And I find that 6 years after the policy, households in treatment districts are a third less likely to suffer from a non-chronic illness. Okay? Or in other words, they have a quarter fewer days that they were ill. And I'm also going to show you that the health-related economic outcomes of households improve. They miss half a day less of work or school due to an illness, and they have significantly lower out-of-pocket medical expenses. And again, we can see this graphically where we see the smoothness before the policy and the discontinuities emerging after the policy. Here on the top, we have the total number of days that household members were ill, and on the bottom, we have the medical expenses. To the left before the policy and to the right after the policy. In the paper, I also show evidence that health also improves along other dimensions, such as vaccination rates or pregnancies becoming safer. But I want to use the last minutes to talk with you about mechanisms, because the question that remains on all of our minds is how exactly does bank presence improve health? So I guided you through potential mechanisms in the very beginning, so let's go through them one by one. The first idea was that banks provide credit to local businesses. These local businesses grow, the household benefits from higher income, and it can now spend more on health. Okay. So indeed, I find that there are important indicators that households increase their healthcare demand. I also find that households 6 years after the policy introduction own significantly more savings accounts and health insurance. The coefficient on bank loans is insignificant, so that doesn't seem to be the driver of health improvements for the average household. And then finally, I use the economic census to show that in treatment districts, so the underbanked districts, healthcare providers are significantly more likely to be mainly financed by an institutional loan. And there are overall significantly more healthcare providers in the area. So there's also an increase in healthcare supply. So let me summarize. The data says that it could be basically almost all of these incomes, except that banks provide bank loans to households. And to further narrow this down, I compare my findings, benchmark my findings to other studies in the literature. These other studies basically show that if we just alone increase income, or that if we just increase savings accounts, there are no improvements in health. And that leaves health insurance and credit to healthcare providers as potentially more important mechanism in driving the results. We need to take this comparison with a little grain of salt, because these studies that show that income or savings account alone don't improve health are in a different setting than my study today. So let me conclude. I use a nationwide natural experiment in India that captures bank presence in terms of access for households, for businesses, for healthcare providers in a large-scale long-term setting. And that allows me to show that bank presence can play an important role in improving health. And importantly, I also provide novel evidence that two aspects of banking were crucial: that households gain access to health insurance and that healthcare providers gain access to credit. So thank you very much for your time today, and I'm looking forward to any questions you might have. I think you're muted.
I think I did see a question here. Let me see. Oh, can the person who just asked the question raise the hand and ask the question quickly, please? Is it Nithi? Oh, no. Who is asking the question? All right. Kim, thank you so much. We are going to actually not have a Q&A, only because, I'm so conscious of the fact that we are running late and Joel and Bidisha are waiting. So we're going to go on to Bidisha's paper. Bidisha, you're all set to start the paper. So we don't have a Q&A. We don't have a break. We're going to start the paper, Identifying HFT Activity Without Proprietary Data. Bidisha.
Perfect. Thank you. I hope you can all hear me.
We can hear you very well.
Perfect. Can you see my slides?
Yes.
Okay,
yes.
Perfect. So thank you, Tirthankar and the organizers. Special thanks to you, Koz. I have been a beneficiary of your excellent moderation for all 3 days of the conference. And especially thank you for asking Joel to discuss our paper, and thank you, Joel, in advance. This is joint work with Carol Comerton-Ford, who is in Australia, so she can't be joining us, and Roberto Pascual, who is actually here. He's in Spain. So this is identifying high-frequency trading activity without identifiers in the data. As algorithmic and high-frequency trading grows in countries around the world, in many places over 50% of the total volume now, increase in HFT activities are also growing. And as the title of this paper suggests, here we are going to identify HFT, high-frequency trading, when there are no identifiers for HFT in the data. We do this by evaluating the popular proxies that are used to identify HFT in academic research. So first, let me explain Why Proxy Metrics? I'll briefly discuss the HFT identification strategies we have currently. First, there are proprietary databases that provide identification. But such data are not widely available. They have limited sample coverage, and in some cases, the identifiers themselves are based on proxies of HFT. Then there are events that change latency, which impacts HFTs most. So researchers use these events to identify the impact on HFTs and indirectly infer high-frequency trading activities. Some examples of this would be the direct market access ban that US imposed in 2011, various co-location activities by exchanges, and so on. But again, these are not direct identifiers, so these are also proxies of HFT activity. And then we have metrics that researchers use to proxy for HFT activity. Since HFT research and the use of proxy metrics is growing, what we are doing in this paper is we're going to evaluate these proxies. So I kind of think of this as a public service paper, really. So what are these HFT proxies? Our survey shows that there are 8 popular proxies used in the literature. Given that I have 20 minutes to present this paper and now we are running late, I was quickly modifying my slides, so I'm not going to actually show the definitions, construction, or studies associated with these proxy metrics. Those of us in the market microstructure area know that 3 of these here are based directly on Joel's work, which is why I'm especially grateful to you, Coase, for inviting Joel to discuss our paper. So these proxy metrics briefly are message traffic, cancellations, monitoring intensity, fleeting orders, quote intensity, quote flickering, speed of response to limit order book events, and strategic runs. So here is what we're going to do. We're going to evaluate these 8 proxies and address 3 research questions broadly. First, how reliable are these proxies? In other words, are they picking up HFT activities? Second, what type of HFT activities do they signal? For example, is it HFT liquidity demand? Is it HFT liquidity supply? And lastly, are there any proxies that are better at identifying HFT, but not other type of traders? And by other type of traders, I mean other algorithmic traders or agency algorithmic traders, or even non-algorithmic traders. So those are our 3 broad research questions. Now, to do such an evaluation, we need actual HFT identifiers against which to benchmark the proxies. We get our data from the National Stock Exchange of India. So Tirthankar, thank you very much. NSE is the 4th largest exchange by trades. And as of July this year, which is the latest statistics I could get, the NSE ranked just below the Toronto Stock Exchange in market capitalization. The TSX had market cap of 2.6 trillion USD compared to 2.55 trillion USD for the NSE. And algorithmic trading in 2018 accounted for half of all volume. So we have a good representation of ATs in the data. What make the NSE data particularly suitable for us are 2 flags in this message traffic data that help us identify HFT, agency algorithmic traders, and non-AT, non-algorithmic traders. The first is the order entry mode flag, which indicates if an order was entered using the algorithmic order entry and management system provided by the NSE. The other flag is an account identifier, which indicates if an order was entered for a proprietary account or a client account. Now, using these 2 flags, we identify HFT orders as those that use the algorithmic order entry and management system and are for proprietary account. Now, that is the classic definition of SEC's definition of HFT. I would like to note here very carefully that the NSE does not identify any individual trader account in this data, and there is no way to infer which message originated from which trader. So trader anonymity is preserved, although this identification remains. Now, for each metric, each of those 8 metrics that I showed you before, what we do is we build 2 versions of the same metric. One using the true, we call the true metric, which kind of uses the flag that we have in the data. The other is the proxy metric, where we use all messages, ignoring the identifier. So basically, we are trying to simulate a situation where if you didn't have the identifier, how would you build that same metric? And then we run a horse race between these true and the proxies by comparing how well the proxy metrics track the true. So that was sort of the context. Now let me present some results. I don't have very pretty tables, but that's kind of, I don't think that's anything special to us. This is all market microstructure studies, too much in the tables. So here's the first research question, where we examine how well the proxies track the true, how reliable are the metrics. So this table presents the correlations between the true and the proxy metrics. And the leftmost column, you have the intervals, which shows the time window over which we aggregate each time series of these 8 proxies. So as you can see, the correlations are all very high and statistically significant, which is good news if one wants to use a proxy to capture the underlying true behavior. It is also nice that the results hold for all levels of aggregation from 30 seconds to the daily level. Now, let me show you the second research question, demand supply of HFTs. Now, to capture HFT liquidity demand and supply, we examine several metrics, including trades where HFTs are liquidity suppliers, HFT presence in the top level, in the top 5 levels of the limit order book, and then trades where HFTs are liquidity demanders. We run a pooled regression with stock fixed effects, double clustered standard errors, and then these regression estimates show us how each proxy metric captures the true HFT contribution to liquidity demand or to liquidity supply using these 5 variables that we have constructed. Our coefficient of interest in these regressions is, of course, the beta. Now, this exercise generates the beta estimates for the 8 proxies, for the 5 measures of these variables, for demand and supply, and for the 5 levels of time aggregation. So there are 8 times 5 times 5, that's 200 betas. I cannot show you all of them, but let me just summarize the results as follows. All 200 betas are positive, and 199 out of the 200 are significant at the 1% level. Thus, all metrics are capable of signaling HFT liquidity demand and supply. Staying with the research question 2, the next result that I want to show you here is for episodes of unusually high HFT liquidity demand or supply. The literature here shows that during normal times, HFTs efficiently provide liquidity, but in times of market stress, their behaviors often change. Now, since our sample period does not have any flash crash type episodes, what we do is we take the 25th and the 75th percentile of the distribution of HFT liquidity supply or demand as unusually low or unusually high. We then create 4 variables when HFT demand and supply are both high, or one is high, one is low, and then if both are low, so that's 4 combinations. And we run a regression to test how each proxy metric performs in identifying HFT activity in these 4 possible states. This table doesn't look very pretty, so I'm just going to explain this using one of the metrics, message traffic, for example. Let's take the leftmost column. What it's showing is when HFT demand and supply are both unusually low, that's 25 percentile or under, the coefficient on the message traffic proxy is negative 245.98. Now, as demand goes high, but supply remains low, which is the next row, this coefficient increases to negative 113, which is a move in the right direction. It's increasing. The message traffic proxy increases as HFT demand goes high, even though supply is low. Now, if instead supply stays low and demand goes high, we kind of see the same move. It's a move to negative 114.26. If both go high, this variable reaches its peak to 231.16. And if you look through the rest of the table, you can see the same patterns along every column for every one of these metrics. Therefore, the proxies actually signal in the right direction when HFT liquidity demand or supply is unusually high or low. The last research question is about the ability of any proxy or proxies to isolate HFT activity from other traders' activities. To do this, we run a two-stage regression. In stage one, we run a pooled regression of the agency algorithmic traders and the non-algorithmic traders on HFT's true metric. So the residuals of this first stage regression are those components of HFT activity that are uncorrelated with these two other types of traders' activities. In the second stage, we then regress the HFT proxy metrics on these residuals. So basically, the beta coefficient in this regression, second stage, should capture how the proxy metric signals HFT activity that is uncorrelated with agency algorithmic or non-algorithmic traders. So here are the results. This table shows that the best fit out of all these proxies corresponds to the strategic runs proxy, which is Joel and Gideon Sarr's metric that they proposed. If you look at the highlighted numbers, the coefficient is 77.59. It has the largest t-statistic and the highest adjusted R-square. For this metric, the R-square in the regressions for the agency traders and the non-algorithmic traders is near zero, indicating that the correlation, although it is statistically significant, is economically irrelevant. Thus, strategic run stands out as the HFT proxy that is primarily driven by HFT activity and not by agency algorithmic traders or non-algorithmic traders. In conclusion, our evaluation of the 8 popular proxies of HFT indicate that they all perform well in identifying HFT activity, and they are all highly correlated with each other. They are good at identifying HFT demand and supply, but I have to point out they cannot distinguish or differentiate between the two. I did not show you those results, but almost all the results go through if we aggregate at small time windows as small as 30 seconds or long time windows as long as the daily level. So data granularity is also not a problem or issue with these metrics. And finally, Hasbrook and Starr's strategic runs proxy is the best at capturing HFT-specific activity. That's all I got for you, and I will be happy to hear feedback now.
Thank you, Bidisha. Great presentation. The discussant is my colleague, Joel Hasbrook from NYU Stern.
Thank you, Kos. I'm going to try and share my screen here, and let's see. Okay, am I sharing it?
Yes, very well.
Good. Excellent. And thank you, Bidisha. That was a very clear presentation of what really is a very clear paper. It is, I think, it's very nice because it addresses a very practical problem in microstructure analysis. So we have these true HFT activity metrics that are dependent on HFT messages being differentiated somehow and identified. For example, simply the arrival rate of HFT messages. And then we have these corresponding proxy measures, which we construct to be parallel, but there the message traffic is undifferentiated. And there are many, many situations where we don't have an HFT identifier. We only have the proxy, and this paper is asking, is it valid? The nice thing about the using the NSE data for this study is that we have the identifiers and we can examine the validity directly. The paper looks at a real kitchen sink of metric and proxy pairs. The questions I'm going to address in this discussion are, how do the proxies correlate with the metrics? And do they have explanatory power for the HFT making and taking, that is, liquidity, supply, and demand measures? So it's really a panel data set. For each metric, we have, for each firm and each time bucket, we have a calculation of the true metric. And the time buckets go from 30 seconds to 5 minutes, which covers pretty much a practical range of what we'd be interested in practice. The proxies are constructed in a similar way. Vidisha did not mention this, but it is these proxies and the metrics are deseasonalized because within a trading session or within a trading day, very often there are distinctive patterns. And so most of what we are doing is going to be dealing with these deseasonalized residuals. For each firm, we look at the correlation within the two time series, metric and proxy, and we report the averages across firms. We do this for all the pairs. The average correlations are in the range 0.8 to 0.9, and I stress these are already deseasonalized. So these are great proxies. It really is very, very comforting to know that they are that good because they are very widely used. Now, by way of follow-up, although we certainly want to remove the seasonals to really get a strong test of the random variation, I'm still interested in how strong the seasonals are, and also how much they line up, because certain things like volume and volatility tend to be concentrated at the beginning and the end of trading. I can think of reasons why the HFT proxies might have a similar pattern, but also reasons why they might be a little bit different. Also, we know in these data that outliers and nonlinearities can be very important. So in addition to the Pearsons, I'd always also like to see, maybe not in the full tables, but in an online appendix, some Spearman correlations as well. But when I see these correlations, and they're great, I think about ways of interpreting them and what imputations we might make. So I went to the NSE website. It's a great website. It's very clear and easy to get information. It is, of course, basically a limit order market with price time priority. The order types are limit orders, market orders, and also stop orders, stop sell, stop buy. There are a few order qualifiers and conditions. One is immediate or cancel. Another is the NSE calls it disclosed quantity, but these are reserve or iceberg orders. And the distinctive thing about this is that when we look worldwide at what strategies people use, often they use a peg and discretionary strategies. And in some exchanges, these are encoded or programmed as specific order types. Now, what are they? A pegged order has a limit price that floats along with the best bid or offer, depending if it's a buy or a sell. A discretionary limit order waits. For example, a buy limit order would wait passively until the offer gets within the discretionary range, and then it will go active. And one of the nice things about doing this with the NSE data is that the order type, the set of order types, market limit, stop, it's very parsimonious. So we would suspect, or I conjecture, that these pegged and discretionary functionalities are going to be implemented by HFT or AAT algorithms. So we might wonder if some of these activity metrics are going to map to these discretionary or pegged strategies. So I think Gideon and I always mostly assumed that the strategic runs, which are chains of cancel and replace a revision, these are going to be mostly pegging strategies. And speed of response, these are in some cases going to be discretionary, because when we see a bid or an ask get improved and it's very quickly hit or lifted, this is like a discretionary strategy that starts passively and then very quickly goes active. So I think some of these metrics are of particular interest because of the kinds of strategies that they indicate. As far as making and taking liquidity goes, these are also a very strong interest because from a policy viewpoint, we tend to like HFTs if they are making liquidity, and maybe tend to be a little suspicious if they are taking liquidity, particularly if they're taking it faster than everybody else. So for each activity and proxy, we really have four regressions. First, are the HFTs making? Are the HFTs taking? And on the right-hand side, is it a proxy or a metric? The explanatory power of the metrics or the proxies is evident in the beta coefficients, and it is really very striking here that whether we use the metric or the proxy, the betas are positive, they're significant, they tend to be reasonable, which is they are close together in the metric versus the proxy regressions. I would point out, though, and Vidisha mentioned this, the proxies are not really sufficient to differentiate between make or take HFT activity. And in these regressions, one of the predictive problems is that we have, or we need, lagged values of the HFT make or take variables. And I am wondering if some of these proxies might be refined to pick up a little of this make-take behavior. So the way strategic runs, for example, are defined, it's a series of components that are maybe they're cancellations, resubmissions, or revisions, and they're very consistent in order size and direction, buy or sell. But they aren't necessarily all passive or all active. And for example, if we see the maker in a trade, they might have been a passive step in a strategic run, or the taker might be a strategic run that switched to being active. And we can detect this in the in how we build the strategic run. Also, in the response rate, we can see the party who was fast, and sometimes they might be actively hitting or lifting an order, or sometimes they might be passively repegging. Either way, though, if it's HFT, we'd want them to be very fast. And lastly, my wish list. This sample is drawn from 2015 and 2016. How did everything behave, particularly in the spring of 2020, where the pandemic was just starting? Most markets had episodic illiquidity. And how did the HFTs behave during these periods of illiquidity? We're also interested in the commonality of liquidity. So do the proxies and the metrics examine or exhibit similar commonality? Are they useful in predicting liquidity changes? For example, some exchanges, IEX in the US comes to mind, form a signal of what they call crumbling liquidity. It's an advanced signal of liquidity deterioration. Can the metrics and the proxies predict these? And lastly, the NSE does have something that wasn't used so much in this paper, the immediate or cancels. They indicate or may indicate what Eric Budish has called races. And it would be interesting to see if these metrics or proxies here are related to the hit rates or the failure rates of the immediates or cancels. So this really is a wonderful paper. It sets out, it achieves very much what it set out to do, document the validity of proxies, and going beyond that, it really brings to mind ways that it might be expanded and extended. So it's really a very nice paper, and I applaud the authors and would like to see the extensions of this. Thank you.
Thank you, Joel, for an excellent discussion. Before I open it up for questions and comments, I want to give Bidisha an opportunity to respond to Joel.
Thank you, Joel. I greatly appreciate your comments. You know, as you were speaking, I was almost wondering, are you a co-author on our paper, or have you been privy to our discussions? Because we've been thinking about some of these and talking so much about how to address these. We are doing some recent work with IOCs. So we will have that in the paper, hopefully in the next revision. The other thing that we were a little bit struggling with is how to distinguish between, HFT demand and supply. Both are signaling the same direction when there are these unusual episodes. And we will very, very soon take these ideas that you have of including the lagged values and see if we can find, any results there. We've been thinking along the lines of doing some principal components to see if we can figure out, because I think it would be interesting to find out if HFT, there are some of these proxies that signal HFT liquidity demand more than supply, or the other way around, because I know that is important in the literature. So everything you have said are things that we are very thankful for you pointing those out. And I'm hoping Tirthankar is listening to the wish list, listen to your wish list, and will give us some 2020 data from the NSE so that we can do that extension. Thank you very much.
Very much listening, and would be very happy.
Yes, Tirthankar, I will follow up with you.
Okay, very good. Yes, Vidisha, I hope you continue to talk to Joel and everything. Okay, any questions? If you have some questions, you can raise your hand or put them in the Q&A, etc. Pradeep, you had a question? I thought I saw Pradeep raise your hand.
Yeah, hi, Koz. Hi, Vidisha.
Hi, Pradeep.
Great paper. I have one question, which is that the way I understood you defining high frequency trading, it appeared to me that you were conflating algorithmic trading with high frequency trading. So when we think of HFTs, we have we have a subset of algorithmic traders in mind. So it's not just machine traders. It's not just people who are interfacing with the system through a machine. It's also people who are following, who are high frequency traders, who trade at a high frequency with specific kind of trading motives. And that's one question. And also, I'm not entirely clear as to what is the economic distinction in terms of market participants between proprietary and agency traders in the algorithmic trading context. Those are my two.
Thank you, Pradeep. Both very excellent questions. So we did not just use algorithmic trading to signify high frequency trading. What we did is within the algorithmic trading group, we have also looked at those who trade for proprietary accounts. Now and those we are calling high frequency traders because the SEC 2010 documents defines HFTs as using algorithmic trading, but then trading for proprietary account, not client trades. And so the others who trade for clients, we have separated them into agency algorithmic traders. And secondly, I completely know where you're coming from with this data because you yourself use this data. So we have done some extensive validation exercises, and I'll be happy to share the results with you to show the speed of response and all of these variables, how the three groups that we have identified differentiate. Are we picking up very, very different trading characteristics amongst the three groups? So we have looked at, for all of these eight of these proxies, we are looking at these three groups of traders and seeing, what's the difference between them. And HFTs, truly the ones we have identified as HFTs, are significantly different even from the agency algorithmic traders. So that's sort of the first baseline we have done.
So when you say proprietary from whose perspective? So are they exchange members or are they, I'm not clear what the term proprietary in this context really means.
So basically, they're not trading on behalf of their clients. It's not a client order that had come in and they are just executing it. It is their own trade. So for example, like Goldman Sachs, in the NASDAQ HFT data, you cannot differentiate between the two.
You're talking about principal trading. You're talking about principal trading firms, essentially.
Right. So basically, even for the same firm, you can identify two different types of trade, even though they are algorithmic trading firms. Some of them are client trades. We do not lump into HFT because they are just they're client trade. So those would be agency algorithmic traders. So we have a sharper kind of identification of HFT here.
Okay. I mean, my reservation is about it's not linked to the trading strategy, and therefore a lot of the time how HFTs are thought about. But doesn't matter. That's fine. Thanks, Vidisha.
Thank you.
Okay. Any more questions? I see a question in the Q&A. Let's see. Okay. Technical analysis dominates the HFTs rather than tangible financial parameters. Your view, please. That seems to be addressed to either Vidisha or Joel. Let me again, technical analysis dominates the HFTs rather than tangible financial parameters. Is that clear?
Um,
Yeah,
Is it?
I think I'll just
I
let
think
Joe answer.
Yeah.
Okay.
The
Joel, you want to say something? Yeah, please.
Sure. First, I don't regard them as inconsistent. Some HFT strategies really use signals that we might call technical analysis. So I really view them on a continuum, and I would expect the HFT and also nowadays the AAT algorithms to be using technical signals.
Suppose, if I may, just a comment on Pradeep's question. Just a comment on Pradeep's question. See, the distinction between client trades and prop trades, as Vidisha has done in the paper, is widely followed here in the NSE markets. So there is a prop as a separate category, and then there are high frequency traders who trade for somebody. So they will be trading for these will be typically investment banks that will be trading for large asset management companies. They would be trading in high frequency, but they're not trading their own money. So I think that distinction between a prop trader and what Vidisha is calling as AATs stands. In fact, in our monthly publications, we provide a clear distinction between the trading share of prop clients, agency clients, of course, apart from many others as well.
In drawing a distinction between that and the Western literature, which is concerned with say, the US markets, that is the context in which I was thinking about this. So the HFTs are more, whether you are thinking in terms of execution algorithms or you're thinking in terms of liquidity supply folks who are HFTs. And we typically don't distinguish between whether somebody is running, there is a prop trading firm running it for somebody, or there is. So that's what the context of my question.
Okay. Any other questions? Any other questions? All right. We are actually going to take a break for 5 minutes. Lata and Meeraj, you guys stand by.
Yeah.
And Poonam is going to discuss the paper. We have a great paper coming up, but thankfully only after 5 minutes. Okay? So we have 5 minutes. Saurabh, you can put up the 5-minute sign. All right. We've been sitting in the same place for a long, long time. So I thought, okay.
Yeah.
Fair enough.
All right. Thank you.
Thanks. Hi, Pradeep. Nice seeing you after such a long time.
Hey, Pradeep. Thank you. I actually saw you in the last few sessions also, but I was off camera, so I don't know if you saw me. But yeah, it's always...
I didn't, and I was thinking she prefers to keep herself hidden. I could see the name, but I couldn't see. I couldn't actually see you. How's your prison work going?
They're not letting me go back in there anymore.
Oh my God. Okay.
So yeah, they're so
Okay, maybe later. I'll just write to you. Sure. Yeah.
Hello, everyone, and I didn't mean to interrupt.
Hi, Poonam. How are you?
I'm good. Hi, Vitisha. I've been listening to all of this. Then I thought, okay, let me just poke in as well.
Please, where were you? Very good to see you.
Yeah, same.
Very good to please. Chari,
Yeah.
Mr. Miraj, hi. How are you?
Yeah, we are fine.
I'm fine.
So I don't know if Koz is back. Koz, could we start, please?
No, I don't think he's back. I don't think he's back. He's not back. Yeah. I think we should.
It's just the chair. It's not Koz bending down. It's just the chair.
It's just the chair. Yeah, empty chair.
It's just the chair.
You can assume he's chairing and start the session. So and the chair is there, so it's fine.
Good one, sir. Good one.
Literally chair,
That was a
huh?
good one.
Yeah, literally the chair is there. And at the end of the day, the folks, there he comes.
There. Coach, did you hear all the
He's-
stuff going on behind your back?
No, what happened?
All the stuff that the people were saying, goes, my God.
I'm sorry. Don't worry. Tirthankar has a private recording of everything, so I'll hear about it. Yeah.
Oh man, we all forgot about that.
Okay. All right. Let's go to the last research paper. That's going to be Lata Chari and Meeraj. Who's going to present? Is it Lata or Meeraj? Who is going to present?
Yeah, myself, Lata.
Okay. Lata, take it away.
Yeah, you might want to go full screen. Yes. Thank you.
Yeah. So my screen is visible, I suppose. Yeah, Tirthankar?
Yes, indeed.
Yeah. And greetings. The last paper of the day, and maybe people are waiting to. I'm probably between all of you and your dinner if you're in India, and maybe you're not at lunchtime if you're outside the country, maybe. So, greetings from me, Dr. Lata Chari, faculty at the National Institute of Securities Market, and my colleague here, Mr. Miraj Inamdar, who is also a faculty member at the National Institute of Securities Market. At the outset, I would like to thank the NSE NYU Starr for actually giving us an opportunity to present this paper on effectiveness of additional surveillance measures, empirical study using Indian market data. Before we actually get into the paper, I would like to dwell a few minutes on the theoretical underpinnings around this topic, and then get into my actual work. Indian capital markets have actually grown immensely in the past 2 decades. Protecting integrity, balancing it with market development and efficiency is of paramount importance to both regulators, investors, and of course to the Indian economy. It was very nice to see Professor Michael talk about so many unicorns coming up in our country, and probably the responsibility of protecting markets is even more under those conditions. So with this background, we know that surveillance is one of the most important tools that actually helps regulators and exchanges to proactively deal with market abuse and stock price manipulations. We can define stock price manipulations as a trading behavior that distorts stock prices with the intent of personal gains. Price manipulations can actually take various formats. The first format is probably a format where the manipulator takes some visible actions like sharing insider information, or maybe falsifying accounts, where the misconduct is actually visible and it is possible to prosecute such misconduct. The second format is, which is of concern and which is more difficult to track and regulate, is the trade-based manipulations, also popularly known as open market manipulations. Here, of course, we know that the manipulator actually takes positions, and these positions are taken with an intent to distort the stock prices through disturbing the demand and supply mechanisms which are actually present in the market. So now actually the problem with this trade-based manipulation, actually as discussed in the literature, relates to challenges to the regulations presented by these manipulations, the difference between how to classify a legal trade from a manipulative trade, because the trader actually uses apparently legal trades to manipulate the prices, and what are the key characteristics. We actually went through the literature concerning these three areas, and we find that Daniel Fisher and David Ross, in their paper Should Law Prohibit Manipulation in Financial Markets, actually make a case for no regulations. What they say is trade-based regulations have low probability of profits, high social costs, they are self-deterring in nature, and therefore they need not be regulated. As opposed to this, we have opinion from Allen and Gale, who actually take a counter view. They say that in a rational asymmetric information framework, it is possible for trade-based manipulators to get away with profits. So this leads us to the next question. If that is the case, how do we actually differentiate a legal trade from a manipulative one? Fetcher, in his paper, Legitimate Yet Manipulative, actually emphasizes that regulators who try to differentiate between legal trades and manipulated trades must not just look at the intent, but also take the effect into account, the effect on the market, the harm caused to the market. So going by that, we read further and look at papers by Huang, Siwai, and Bolling, which actually look at convicted stock market manipulation cases in Vietnam and Taiwan, and they come out with key characteristics of manipulated stocks, which are identified as presence of market dominating investor, point number one, and then they are generally done in counters which are less liquid, and then there is the presence of the effect, which is the artificial price. So they mention these three characteristics. So what do we take away from the literature? We take away that irrespective of whether a manipulator makes money or not, any action that is aimed at distorting prices or creating artificial prices needs to be regulated. Profits can also come from outside the market through maybe activities like either preferential issues or pledge of shares, etc., etc. So we just cannot ignore this act. Secondly, we now have a set of characteristics which can be used to understand and differentiate the legal trades with the illegal ones. So this is precisely the literature setting which actually enthused us and made us think about the short-term additional surveillance measure. It feels like this measure takes into account whatever has been already discussed in the literature. So what it does is it tries to identify stocks which have seen the artificial price effects, and also takes into account the existence of a market dominant player who has been participating in the past few days. So it looks at artificial prices are actually measured as aggregate of 25% increase or fall, and pegged against the Nifty 50 variation for the same period. And then when top 25 clients hold more than 30% of the total volume, we would like to call or use it as a proxy that there is a market dominating investor available in the trading that has happened in the past 5 days. So this is generally measured in a trading period of 5 to 15 days. And based on these two triggers, a stock gets included into the STASM category. Now, when it gets included, what happens, right? The actions which are initiated against such stocks include increasing the margin by about 1.5 times the current margin or a maximum of 100. And then here you can also see a targeted, what shall I say, a targeted impact on the top 10 trading clients who have gross traded value of more than 10 lakhs, who will be levied an additional 100% margin on the value of trades as of end of the day. So what this actually does is it tries to deter manipulation in two ways. Point number one, the capital required is getting increased. Point number two, the cost of capital will have profit-related implications to the trader. Having said these two things, when do the stocks really go out? The review on these stocks is actually done after 5 or 15 days, depending upon how they were included. And if the stocks really don't meet the criteria which is laid down in the inclusion here, they will be allowed to exit from the ASM category. So this is the framework of short-term ASM. What are the motivations for, other motivations for picking it up? We've been watching in the newspapers off and on that surveillance measures taken up by the exchange along with the regulator has actually impacted markets. We can think about price actions. And then, off late, I think sometime in August, we saw again another news report which said that the Bombay Stock Exchange had implemented additional surveillance measure, which caused huge price action in the small cap and the mid cap stocks. So we just wanted to verify the veracity of these news and really see what is the impact of these surveillance measures, what are the ground realities. So the research objective is to ascertain the impact on the announcement of inclusion of stock into ASM category. We look at both the returns and we also look at the traded volumes. The objective number 2 is to ascertain the impact of the exclusion event on both returns and traded volumes. Objective number 3, after actually looking at these two things, we also saw that stocks which came into ASM came with cumulative abnormal returns which were positive, but however continued after inclusion to either remain positive and others which actually reversed their price patterns. And then the same thing with the negative. We saw stocks which came into the market with a cumulative negative abnormal return. And then post-inclusion, we saw some of them continuing the trend and others actually taking a reversal. So the idea was, after ascertaining the impact on the abnormal returns, can we really look at whether there is any difference in the liquidity impact and relate them to the price patterns and see whether different price patterns are actually showing some difference with respect to the liquidity impact and speculative interest. In the Indian capital market, actually, we have actually used a research methodology where we are using the classical event study models to look at the price impact and also to look at the volume impact. We are using OLS dummy regression framework to look at the impact on liquidity and percentage shares, that is the speculative activity surrounding the event. Here, when I'm talking about the speculative interest or activity surrounding the event, I would like to say that in the Indian capital markets, the intraday trading data in terms of the percentage of shares that has been allowed for a delivery is shown on a daily basis. What we've tried to do is we've tried to exploit this information and say that speculative interest, that is, if the percentage shares delivered data for cash market stock is actually falling, it means that the speculative interest in that stock has actually gone up. And if the percentage shares delivered to the total trade goes up, it means the buy and hold investors are probably participating more in the market. So we have tried to use this information as a proxy to probably look at what is the speculative interest in the share surrounding the ASM event. Is that anything different, and can we see differences in this interest across this period of pre-inclusion, post-inclusion, and post-exclusion? So I have actually swapped my PPT looking at the time overruns, and I've put in a quick look at the results, and then I will be following it up with the details on the methodology. So what are the quick look at the results or the results preview? You can see that the daily average abnormal returns on stocks that are actually using the event study, what we generally see is the daily cumulative abnormal returns is actually after inclusion, we can see that the abnormal returns are getting controlled. Daily abnormal returns are getting controlled. And post-exclusion, we don't really see them shooting up or shooting down. They seem to be more stable. With respect to abnormal volume, what we see is the abnormal volumes actually shrink, and post-exclusion, they continue to remain more or less stable, which is what we see from the event studies. Next, the cross-sectional regression analysis, where we try to understand the cumulative abnormal return and its relationship with the cumulative abnormal volumes and the liquidity and the speculative activity, where we see that abnormal volumes and trade size actually increase with CAR, that is the cumulative abnormal returns, and this is very intuitive. And a lot of earlier studies, like studies by C.Y. Huang and studies by Bowling, which look at Vietnamese markets and Taiwanese markets, have similar results. Going into the liquidity part, we are pretty much using the popular liquidity measures, which are used by the papers which we have already referred in the literature before. And we look at the liquidity in the post-inclusion period actually falls, but for companies with positive CAR, the liquidity continues to remain positive, right? Which means companies which come in with a positive cumulative abnormal return don't see any shrinkage in liquidity. The percentage shares delivered is actually positive for companies with a positive CAR, and we've used a interaction variable that actually looks at positive CAR and the post-inclusion period, and positive CAR and the post-inclusion period with continuation price patterns. So we have two interaction variables. So what we see there is the percentage shares delivered is positive for companies which enter with a positive abnormal return. And for those companies, when they continue holding on to their positive returns in the post-inclusion period, we are actually seeing that the percentage shares delivered continues to remain positive. So, what does it really imply? When we look at the event study results, we can actually see that there are no steep falls and there are no steep shocks, as we can see, but then with abnormal volumes, we see them stabilizing over a period of time. So volume adjustment does not happen immediately, it happens over a period of time. When we look at the cross-sectional and the differential impact on liquidity across various price patterns, we can actually see that the market response is more measured. It's not the same across all kinds of stocks. What we can see is stocks with positive CAR and continuation trend seem to have more delivery in the post-inclusion period, which means maybe there was more speculation in the pre-inclusion period. But in the post-inclusion, we see that delivery trades are actually more than speculative trades. So going into the event study methodology and its results, we will take up both the event study and the regressions. what we can see is, of course, we look at the hypothesis that STASM does not affect stock prices which are abnormal, which is pretty much the classical hypothesis. Getting into the sample of the study, we actually took up data from 18th November up to 28th February. We had about 245 events. We examined the pre-inclusion estimation period for various events like mergers, acquisitions, etc., which could have distorted the prices or caused an impact to the volumes. And we removed stocks which actually had these instances happening during the estimation window. And then what we ended up with is about 218 events, 218 events on inclusion and 218 events on exclusion. And the total number of companies which were there was 188. And overall, we had about 872 events, which came into STASM starting from 18th November till 28th February and got excluded at different periods of time. The paper talks about for how long and how many companies were there, for how many days within the STASM, etc., etc. From there, we can see that more than 50% of the companies were in STASM for a period of less than 10 days, and others were there for a longer period. So that's about the data. Here, this actually shows how the event window was actually formulated. So we have the event inclusion day. Then generally stocks are there for a period of 5 to 10 days, but many of them, about 50% of them were there for more than 5 to 10 days. And then this is the exclusion event date. And then we actually did the analysis for a period of 10 days post-exclusion. The idea was to see if the stocks actually became exuberant or whether liquidity continued to hold on. And so therefore, we extended into the post-exclusion period. So we gave a buffer window of 30 days before the pre-inclusion, in order to take care to see that what actually triggered is actually not included in the estimation. And here is the estimation of about 120 days. And then this is pretty much the classical model where you look at the abnormal returns as a function of expected returns, excess over expected returns. And then we have the CAR and then the average abnormal return. I think this audience does not need an explanation of this. So we just get into the volume. As per the paper of Campbell, what we really did here is in order to normalize the volumes, we took a log, but then we increased the number of shares traded by a small number. And this is similar to what Campbell and Vasley have actually followed in their study. And we just followed the same procedure so that log 0 does not become undefined. We found about a dozen instances where companies had no trades on various days spread across the estimation window. So we substituted that data with forward filling of the prices, and with respect to volumes, we actually did this. So this is a graphical representation of our results. What we can see is here in the inclusion window, you can see that the abnormal return has been spiking up, right? The daily average abnormal return has been spiking up, and this is your event day. And the post-event abnormal returns have remained very, very stable. You can actually see that they remained as tightly as they were in the 10-day event window. This is the plus 10. And the minus 10 day, you can actually see that they seem to be returning back here to the same levels as they were here. And the cumulative average abnormal return, you really don't see a huge fall here like it is getting made out in a lot of news. Okay, so getting into the exclusion window, the idea is to see post-exclusion what's really happening to the returns. I would like to explain this part of the exclusion window because you see that in the pre-exclusion period, how is it that the shares are showing some huge abnormal average abnormal returns like this. So I'll just go back by a slide and then probably that's easier to explain. What you can see is there is some overlap. We know that 50% of the stocks have been moved out of the inclusion window within a period of 10 days, which means the pre-exclusion period, maybe a few days, is getting overlapped into the inclusion period. And that is something we are actually seeing here in the 10-day event window. We decided to start with 10 days because STASM is a short-term ASM initiative, and there is no point in trying to go deep into the long-term detail. Next is this picture is actually trying to show both the prices and volumes, and then we see that the average abnormal volumes have actually fallen, and then they continue to remain more or less stable after exclusion. Here you can see them actually gradually falling, and then you can see them maybe picking up close to the 9th and 10th day, but they are within a very tight range. So getting into the significant tests and results, we are finding that the inclusion test results show that they are significantly different. And across the exclusion window in the 5-day, you can see that they are not really significant, which means they have come back to their normal levels. So this is the result of the volume analysis. As we already discussed, you can see that in the inclusion window, you can see the volumes actually being significant in the pre-period. And as I was saying, the volume effect is tapering off more slowly as compared to the price effect, which is actually visible there. So getting into the regression analysis, we first classified the stocks, like I was saying, into ones that actually show a continuation price pattern and reversal price pattern. The idea was in keeping with various technical analysis and studies, the idea is to see whether liquidity dries up in one of these patterns but continues to remain great in others. Can we see some differences as far as liquidity and speculative activity is concerned? So we actually devised the dummy variable regression framework, where before getting into it, here we have tried to look at CAR, that is the abnormal return, with the standard stock traded by stock outstanding, which is one of our liquidity measures. And then we have looked at the log of the trade size, which is actually the number of stock traded divided by the total number of transactions. This actually represents the percentage shares delivered. So if this is increasing, it means delivery trades are more. And we have again looked at the size impact also in keeping with the past literature studies, which have looked at size as one of the important parameters, differentiating liquidity, etc., etc. So, what we see here is we see very intuitive, like I was saying, the volumes are actually increasing with increase in abnormal returns, and we can also see trade size showing some significance. So this is the price pattern and positive CAR with continuation in the post-inclusion period. We have looked at the price pattern, right, and how it affects the liquidity measures. One is the turnover ratio and the other is the trade size. We find that the trade size is not significant across both price patterns, that is the continuation and the reversal trends. But then we do see that in the post period, we can see that see significance with respect to the shares traded by shares outstanding, that is the turnover ratio. So what we can see is in the post-inclusion period, we can see that the turnover ratio is positive. And what we can also see is in the post period, it is negative. And we can see that for positive stocks which come in with a positive CAR, it is actually positive. Okay, so which means we can see falling liquidity in the post-inclusion period. But however, for companies which are having a positive CAR, the liquidity is really not falling. So when you go into, we would have loved to see some action in this interaction variable, which is actually interaction of positive continuation and post periods, but we find them all to be insignificant here. So the next slide is trying to measure the percentage shares delivered as the dependent variable, and we are trying to understand whether this is different for stocks in the post-inclusion period, and then for stocks which have a positive CAR, post and positive, and the interaction of the three variables, positive, continuation, and post. This is reversal and post, negative, etc. So what do we really see here? We again see that in the post period, like in the earlier slide, what we can see is this post period is not really significant. However, for positive stocks, what we can see is the coefficient of percentage shares delivered is negative, which means there was more speculation with positive CAR stocks, whereas in the period post and continuing trend and positive, these three things put together, what we see is delivery trades have actually picked up. It is more positive. Okay, so with respect to stocks which have actually, what we see is positive, reversal, and post, which are showing a reversal trend, we are actually seeing that speculation continues to be negative for positive stocks, and in the post period also it continues to remain, the level of speculation is slightly more because delivery is actually negative. So so that's why we would like to say that on the one hand, since there are no steep falls, we don't see really shocks, and on the other hand, what we can see is probably participants seem to have their own strategies in place, and then the fall in liquidity might indicate that the undesirable liquidity, in terms of which can be either manipulation or an uninformed investor getting into this trade, is actually now told through the trading screens and on the website that the stock has entered into or has been categorized as short-term ASM, understands that something which is not really normal is probably happening and tries to keep away from these activities. So I would like to say that any fall in volume is probably more useful, because a person who is informed and knows is probably not getting affected and he's continuing with his trade, and the uninformed people are probably jumping these trades and keeping out of them, and which is what the regulation intends to do. We don't find any great significance with respect to size. We see that the size variable is more or less insignificant across, and these are repetitions of post turnover being actually more falling, etc. So we don't see.
So Lata, 3 minutes, 3 minutes. Yeah.
So I'm really done, Professor Kose, right? And then what do I see? I would just like to stress on the key contributions. We see a fall, and most of these have been already shared earlier. I would like to go into the last one. The criteria for inclusion of stocks into STASM is actually relying on the artificial price effect and the presence of a dominating investor. Whether we should consider combination of volumes and percentage shares delivered, because volumes can give can be a leading indicator, is what we tend to feel. And again, the benchmark which is being used is the Nifty 50 index in ascertaining the price, whether the abnormal volumes are there. So whether the regulators can consider looking at a small cap or a mid cap index, these are some of the things which we thought we may probably speak aloud. So with these few words, I would like to conclude with a disclaimer saying that whatever we have presented here are our own views, and they are neither the views of the institution I represent nor the parent body. So thank you very much.
Thank you, Lata. Nice presentation. Poonam Singh is going to be the discussant. Poonam.
Thank you, Professor Kose. I'll just share the screen.
Yeah, Lata, yeah, you have to pull down the,
So I suppose my screen is visible.
Yes.
Thank you very much for the opportunity to read and review this paper, and as well as, witness this.
Poonam, if you want to make it full screen mode, you can. Right now, it's not. Yeah. But if it's a problem, yeah. Very good.
Sure. So, and of course, thank you, Professor Lata, for the excellent presentation.
My pleasure, Poonam. I would like to also thank you for actually giving in your insights for our paper.
Sure. So I will just set the context first for where this study stands in the literature and the regulatory setup. So we are talking about open market manipulations here, which we understand are legal transactions, and hence they are not sourced through any deception or fraud, etc. So automatically it draws the attention of lawmakers that how do we characterize these transactions as manipulative on one hand, and when do such transactions become manipulative in the first place. So there is a growing, I think, literature in the legal framework that I came across, and thanks to this paper I got drawn to this literature, where the argument is in terms of how do we characterize these kind of transactions. And if Fletcher, this is a Duke University paper, so which argues that ideally the transactions which are going to impede market efficiency or say hurt the integrity of the market are the ones which would be considered as manipulative. But then the next question arises, that how do we identify this? So identification of these kind of transactions again becomes an important criteria. And so there objective criteria need to be in place. And that is where the surveillance mechanisms that we are seeing that has been introduced by SEBI with the help of the exchange rates, who are at the forefront of applying or implementing these surveillance actions, come into play, because they clearly define objective criteria. In the context of India, we specifically can talk about these two surveillance actions. One is the additive surveillance mechanism, which is the talking point of the paper here. And also I would like to draw attention to another mechanism which is in there, the graded surveillance mechanism. In fact, in relation to this, I wanted to draw attention of the authors to another paper, similar paper. Actually, it is by Nidhi. I think she was here some time back. And it was, I think, part of the NSE NYU conference in 2019. So there they address actually a very similar question to what we see here, which is on the implementation or impact of graded surveillance mechanism on the price and the volume impact of stocks which are put in surveillance under this window. So I will come back to this study in a while, because automatically, we end up making comparisons as to, how these two very closely linked papers are, the results, what do they say? Now, coming to the paper that we are, of course, I'm discussing today, is about the impact of additional surveillance measures, which has been introduced by SEBI. What this paper does, as you have all seen, is considering an event study around the point of inclusion and exit of the stocks which come within this ASM window. And in the previous slide, I just mentioned the criteria which kind of brings these stocks within this window. And as mentioned by Professor Lata already, that this is within a 5 to 15 day window that, the whole action that we are looking at. Then the paper goes on to discuss the, say, impact, this has on market quality measures and the volume and price activity. What is interesting further is that the paper tries to look at the heterogeneity within these stocks, which have all come inside this window. And there we look at the, say, liquidity impact and the speculative studies that we were just discussing. The topic, I really found it very interesting. And incidentally, we are seeing a number of papers around this time from different perspectives looking at this whole open market manipulation study. So while market manipulation has a wide literature, but per se open market manipulation, I saw quite a few recent studies, both from the law as well as some empirical literature as well. So this paper intends to contribute to this literature and understand the implementation or effectiveness of this mechanism. Now, while I was quite liked reading the paper and got really interested in the results, where I had a point of concern, and I'm sorry, I really sent the comments very late for the authors to really have a look at it before the conference, was in terms of the research design. So what we see here is that we are studying the stocks or the, say, cumulative abnormal return around the stocks. Specifically, those are within the ASM window. So I'm not sure, and of course, when we look at the price impact or volume impact, they are intended by the regulation or the window in question. So then comes the question that should we have some counterfactual in order to, establish the causality in this case. So my suggestion in that context was, and this is what in fact the like Nidhi's paper also does, is have a matched set of control firms which are outside the ASM window, and then do a difference in difference analysis to see, and especially when we see that we are looking at reverse patterns. For instance, in some cases the cars are continuing the trend, in some cases we see reverses and so on. So there could be some other story, some other explanation which we are missing out if we look at only these stocks within the ASM window. So one is from the causality aspect, and one to dig more information to really get a comparison. So this would apply for both the price and volume study, as well as, say, the liquidity and speculative study we get. Another point that I had with respect to the question relating to the liquidity and speculative study was that, again, the patterns that we are identifying are within the window. So is there a way to, say, including ownership or some criteria to identify the companies and differentiate them before they get into the window? So like an ex ante, some classification of the firms. So I'm going to again highlight this in the next slide when I talk about more interesting questions. One more point regarding the methodology issue, which I think Professor Lata had highlighted when she was talking, was this the overlap between the inclusion and exclusion periods that we see. So while I understand, most of the literature looks at this in the 5-day or 10-day windows, but here the whole action, as I was mentioning before, is happening in that 5 to 15-day window. So when we are looking at a 21-day card, for instance, so already and we are looking at the impact of inclusion, but 107 of the 188 stocks, or 218 stocks are actually out. So probably if we still want to do that 21-day card, those 107 stocks probably need to be segregated, and then we look at the effect. So that might explain that or give a reasoning for that upward slope that in the stock returns that we saw in the graph which Professor Lata had highlighted. So similarly, I think for the exclusion period also, we are seeing a similar mechanism that there's this overlap happening between the event window of study and the two events in question, which is the inclusion and exclusion. So these are some minor points that needs to be looked at from a methodological perspective. But like why I'm not discussing so much on the results is because I feel that in this context, a difference in different, there should be a control and experiment mechanism to see like what is really happening and how much of, there has to be a counterfactual. Coming to some other interesting questions that pop up in the mind when you see the paper. So when you see a good paper and a lot of detailed work, your wish list also tends to increase. So one question that when we comment on the effectiveness of a mechanism is with respect to whether the criteria applied was correct or not. So it can be, as of now, the paper takes the stocks which are listed within the ASM as given. We are not asking the question whether they were supposed to be in that window or not. So that can be a question which would interest us. The second, which I was referring to before, was with respect to the stylized facts regarding the stocks which get included. So in terms of ownership, probably, or say other characteristics. So as of now, I understand we are looking more from the market capitalization perspective, but maybe valuation or even industry concentration could be questions if do we see some clustering there. Again, so one point that we must have noted, when the presentation was happening is that we have 218 observations, of which 188 firms. So hence, within that 3-month period, also we do find repeated offenders. That means the same firms are again coming back to the ASM window within the 3-month gap. Now, if the period of analysis is extended further, because this is around 2018, so we have as of now data till 2021, has the market learned? This is from the time when the law was introduced, but now has there been a learning? Do we identify some patterns or industry concentrations, or say investor stocks? Is there identity of the investors? Those are some questions that were coming to my mind. In that context, again, another thing was, is there any relationship, say, in this graded mechanism and the additional surveillance mechanism that we are seeing here? So is there a way even to consider both these regulations together and see, why was the additive surveillance required in the first place, probably when already a graded mechanism was there? So these were, some questions that were popping out in my mind while I was studying this. They may be part of this paper or, a future research question. And finally, to comment on the regulatory architecture that we see around. So there is the US literature which shows that there is no administrative sanction as such for or a surveillance mechanism in place the way we see it here. While this Bowling paper that we were seeing is talking about similar administrative sanctions in a Chinese context. So probably another interesting area of study around this open market manipulation is with respect to looking at the cross jurisdictions, how the different treatments of regulatory mechanisms are there, and is there any correlation with the, say, market efficiency or developing market, etc. So these were my thoughts. I think I had a quick discussion here. Again, thank you very much for giving me the opportunity. So I rest my case. Thank you.
Thank you, Poonam. Excellent discussion. So I can open up for questions, but before that, Lata or Meeraj, would you like to respond to Poonam?
Yeah, Sama.
By the way, I want to thank Poonam for giving you some comments ahead of time. I really appreciate that. Okay. Go ahead, Lata.
Yeah.
So thank you, Dr. Poonam, madam. So you have made very insightful comment. Even before also for improvement this paper, we have incorporated some of comments, and also we are keenly looking on in future, we are also going to incorporate your suggestion. So some of my observation on your comment is that I have also fortunately attended the Nidhi presentation in 2019, where she was discussing about GSM. But GSM as CASM, the criteria for filtering out is different here. And we have included lots of other parameters for evaluating whether it is effective or not. You have suggested about DID method differences. So as I have studied, and yesterday one paper was also on this DID method. So here there should be a two sample where one is a control group and another is a counterfactual group, treatment group and control group, and which should be separated by time. So I think in event study itself is the estimation window and the event window itself are different. So these are the different time separated one. But the problem here in while creating the counterfactual is that most of the finance where the DID is applicable in finance paper, we have seen that the event where the market wide. So here you are finding the events are the stock specific events. So creating the counterfactual samples, yes, is difficult, but we will definitely try to see the more literature on it, and we will try to incorporate one. So you have given a very good suggestion for this overlapping. So we will do various different kind of the event window. We will try and see the impact, as we have already separated the sample with which are covering under 5 days, 6 days, 7 days till the 10 days, 20 days. So between the sample also we can see that how this impact is having. As far as this regulatory aspect, the filtering criteria, how it's effective, or how we can improve this one. So one is that it's considering means when the regulator or exchange is applying or asking company to into the STASM, they are considering this beta of the Nifty. But most of the stock are not belong to the Nifty. So as we can suggest here that if we see, which Dr. Lata also said in her conclusion, that we can consider the mid-cap index beta and then see that how many stocks are covering, because both have the near about the same volatility, means mid-cap index, or if those stock are belonging to the mid-cap. So thank you. These are my comment, and Dr. Lata madam, if you have any insight, then please.
Yeah, on the ownership issue, Poonam, I think we've gone through the CMIE Progress database, which actually provides the breakup of promoters' holdings and other holdings. What we've seen is for a lot of companies, there has been no change in the ownership holding pattern, but we have seen small changes in the non-promoter holding, that's the institutional holding patterns, and not for maybe it was very few in number, and therefore we just did not proceed with looking at it. That's one. And second thing is the term offender. I would like to say that they are not offenders. What the regulation says is they are not supposed to be construed as offenders, because it is not legally proved that they have done any offense at all. It is just that the characteristic patterns are similar to companies which are generally manipulated. And the Indian regulator is keen to flag off this So that in a country like India, where of course you know that 2 million retailers have entered into the market in the past 2 years, and protecting investor and protecting the integrity is very important. So I don't think we would like to call them offenders, but then their share price patterns are similar, because there is no conclusion which calls them as offenders. Then on the criteria, I think it is largely based on Bolling and others who have looked at actually common criteria across speculated stocks, which are actually deemed speculated through the legal process in place. And it has been incorporated into this. And then industry correlations, we have gone through the circulars on each of the day, and we don't see sectoral bunching of different companies on any one day. And they are actually spread across so many sectors, and we see a maximum of 10% concentration in one sector, something like IT, etc., which we've given in the paper. Cross administrative jurisdictions, yes, that's quite interesting. And thank you very much, Poonam. It was actually a pleasure getting your insights. Thank you. We are open for anything more.
Thank you, everybody. Are there some questions from the audience? Okay, let me make. By the way, I want to thank you. You guys did a great job, and Poonam, thank you for all the comments and everything. Let me make 2 small comments. As you were presenting the paper, I realized I have written a theory paper on what can be called market manipulation, where they're not doing anything against the law. So what we looked at was, these designated insiders, people who own, for example, more than 5% of the shares or something like that, they could potentially sometimes have proprietary information because they are major shareholders. So and sometimes they don't have any information. They're just like any other shareholders. So then they can strategically trade because with the probability, they might have superior information. So they can kind of trade to fake out the rest of the market, basically. So we looked at the equilibrium, and what we are showing is that even though they're not breaking any of the laws, they can actually manipulate the prices in equilibrium. So this is something I wrote it with a former student of mine, Ranga Narayanan, and that was published in the Journal of Business. That was a journal which used to come out of University of Chicago. Unfortunately, they stopped publishing, but it was a good journal. So that's one thing. Second thing, we do have a kind of India research family. So you can reach out to Nidhi or anybody else who is here, and maybe get some comments, etc. That's completely okay. Even though Poonam has given excellent comments already, so that's all great. Okay. I think let me call upon. One more small thing. Eventually the objective is that you guys will be publishing this paper in a journal and things like that. So I was just reading through your paper yesterday. You may want to kind of look at the formatting, which is a small thing, but still, make it more like a standard journal formatting. I think you had very small margins and things like that. It didn't look quite like a serious paper. There is a behavioral aspect to referees and editors. So that's something you want to do. Okay, Tirthankar, I think we have come to the end of a glorious day. We had a fantastic keynote speech and some excellent papers, excellent discussions. I'm going to pass it on to Tirthankar, but hopefully next December, we'll meet in Mumbai and, have a wonderful time. Tirthankar, take it over.
There, by saying that, hopefully we have a wonderful time. Next time you took away my pitch, sir.
Oh, I know, that's okay. Yes,
No.
Some speeches are worth repeating. Go ahead.
So it's not often that one has a keynote address where the visiting, the speaker, although not from India, knows more about India than many people, and probably most of the audience. And the depth that Professor Spence actually showed in discussing India, one would be forgiven for thinking he was probably consulting an Indian firm, on a regular basis, or probably he was engaged with India for a very regular basis. One saw.
I agree.
One saw something very similar in this, the address by Professor Damodaran as well. But he is Professor Damodaran. He knew more about Indian companies, including the recent ones, than many of our market participants, and he brings the depth of academic rigor with him. So we had a 3-day conference. Again, one should not self-certify, sir, but I think we can safely call it a winning conference. I mean, with and 2 excellent keynote speeches, and excellent, absolutely erudite panel discussion on a very, very important topic.
Yes, I was really surprised at how much I learned from it, because now, last couple of years I've been doing research on fintech and CBDC and everything, and yet, just the dynamics of the discussion raised so many very important issues, and I learned a lot. And I really plan to watch the videotape of the panel discussion again and again. And similarly, Aswath Damodaran's talk, lot of things I learned, even though, I'm in corporate finance. I wrote an email to Aswath saying, even though his talk had a practitioner aspect to it, as a researcher, I got about 5 or 6 ideas for doing research papers, So because it was really new ways of looking at things, and the whole life cycle of a firm, life cycle of a product, etc. So there was a lot of gold nuggets in that speech. So this was, yes. And similarly, Mike Spence's talk. It really surprised me how much he knew, and, so it was really great. Yeah.
So, on this note, sir, I would like to take the opportunity to thank all the presenters of the supported papers, presenters of the policy papers. Really, really good work. Yeah, especially Miss Kramer. The intuition from her paper was amazing. I mean, in terms
of
how
it's a major issue. It's a major issue. Yes.
It is. And
yes.
Amazing amount of work there. I'd like to thank all the discussants, Professor Joel Hasbrook, Poonam, I can see right here. I would like to thank Professor Pradeep Yadav for entertaining discussions, very important questions. All the papers were absolutely fabulous, really great work by the discussants. I would also like to thank the marketing department of the National Stock Exchange. Some fabulous work. My colleague Saurabh Mehta is right here. Saurabh, take a bow. Really, thank you. Thank you.
Yes, for very fantastic. Exactly. Yes. Yes. The whole team. I wanna say the whole NSE team has been just incredible. Okay, so in other words, working with you guys, Tirthankar all the way, Ashiana, Saurabh, everybody of your team, just amazing. And just not only in the structure, by the way, I also give them a lot of credit for the organizational part, because a lot of the ideas I would talk to the team, what is the next step to go, for example. I think the whole panel discussion, for example, started with your team. And I happened to think about Subba, who was actually my classmate and 1 year senior to me. He overlapped 2 batches from IIT Kanpur. So that's how it all started. And then, of course, I discussed with you, and then, come up with ideas and everything. So thank you guys. It's a wonderful collaboration.
And, sir, we work under your guidance. So really, I mean, you've been fabulous. The day after the first day, I was asked, questions by my colleagues at NSE. How do you get these guys? How do you manage? And I said, no, we have what is called a Brahmastra. We have Professor Kose John. So
thank you. Yeah, thank you. Yes, by coincidence, Mike, it's a funny story. He was my colleague, but when he was my colleague, like I would ask him, because remember, we discussed Mike before, and I would ask him, would you do a keynote? And he had conflicts all the time, but he remembered. And then this time he was completely open. And in fact, he has told me, you call me again, and I'm happy to talk about another topic, so.
Wow. No, that will be nice. I mean, in our team, we were discussing, just like you have Erdos numbers, you should have a course number.
Thank you. Thank you, guys. Thank you.
Thank you. Thank you. Thanks a lot, sir. Thanks a lot to the audience. We've had some fabulous audience this time. Over 500 people attended Professor Damodaran's lecture. We've had some great questions, great discussions. And on that note, sir, we should bring the 9th NSE NYU conference on the Indian capital markets to a close. Thanks again to everyone. And ladies and gentlemen, have a good night or rest of the day, depending on what part of the world you're from. And
that's right.
Thank you.
Thank you. Thank you, everybody. Thanks a lot.
Thanks a lot. Thank you.
Okay. Thank you. All right. Bye-bye.
Bye.
Bye-bye. Thank you.
Recording stopped.